permanently shutting their doors, I'm so glad that we now have President Biden providing leadership from the White House and a real plan to tackle this crisis once and for all. With Democrats now in control of the Senate, Congress can carry out that plan and provide the nation with the relief it so urgently needs. This committee has advanced legislation in our jurisdiction to implement President Biden's American Rescue Plan, and the full House will take up this legislation later this week after gross, if not criminal, mismanagement of the crisis by the Trump administration. Americans have shown that they want competent leadership and decisive action to crush this virus and put the economy on the road to recovery. But even after Congress passes the American Rescue Plan, the country still needs the Federal Reserve to adapt and to stand ready to use all of its tools at its disposal to ensure an equitable and swift recovery. It is long overdue for the Fed to reconsider its normal operating procedures and use its authorities to tackle the racial wedge and employment gaps. The Fed must act vigilantly against ongoing signs of systemic stress, putting a stop to the deregulation that preceded this crisis. The Fed must continue to be attentive to inequality as it oversees this recovery, taking the impact on consumers and small businesses into account when considering mergers in the financial industry. And the Fed must proceed with greater alacrity regarding climate risk in its supervision of financial institutions. The Fed has recently taken a few steps in this regard, but much more is needed to combat the systemic and extensional treatment. I look forward to your testimony and to discussing these matters today. I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 5 minutes.
Chairman Powell, I'd like to commend you again for your swift response to the pandemic. The Federal Reserve was the fastest acting part of the federal response, thanks to your foresight and leadership. As we've discussed previously, Chair Powell, there is a clear distinction between what is fiscal policy and within the purview of Congress, and what is monetary policy and within the purview of the Fed. I appreciate your work to protect the independence of the Fed, and I know that you'll continue to do so. We have politicians that are talking down our economy, even the Speaker of the House saying, quote, the economic crisis is accelerating, end quote. And they're saying this specifically to pass their spending package. Our economy is on the mend, despite what politicians parrot as their preferred narrative. The first phase of the storm is passing. Now we have to deal with the damage COVID wrought, and it did indeed bring significant damage. And the virus, the shutdowns, schools not reopening, the lack of childcare, all have had serious consequences. These are maladies which the Fed cannot fix. In fact, Congress doesn't seem to have the power to do it either. It's governors in the states they lead who are showing the path forward. Money alone will not fix it. Vaccines, testing, treatment, and data-driven public health decisions will have a larger impact than either monetary policy or fiscal policy at this stage of the game. What's called for is targeted temporary relief directly related to COVID, not a typical Keynesian stimulus bill in the name of COVID relief. To be clear, we know there are many Americans still suffering. Behind every statistic is a family that is still reeling from this crisis. For a year now, we have been working to reach those in need. As you've said, Chairman Powell, this is a tale of two recoveries. Employment for the top quartile of wage earners has fallen by 4%, while the bottom quartile has dropped by a full 17%. So let's dig deeper here. More than 4 million Americans have been unemployed for almost a year. In the restaurant industry alone, 1 out of 6 businesses have been shuttered since last March. And while the CBO projects the unemployment rate, which currently stands at 6.2%, which by the way is lower than the unemployment rate under the first 5.5 years of President Obama, that unemployment rate will continue to fall this year and to reach a pre-pandemic size of 2022 under the current, without any other additional fiscal action. There are millions of Americans, families juggling work, childcare, and paying and just praying that their schools will finally reopen. Yes, personal incomes have actually increased at the end of last year, and the personal savings rate stands at over 13%, a level not seen in 4 decades. Yet childcare costs have jumped by almost 50% since last year. A year ago, women outnumbered men in the workforce. And since the pandemic, 2.5 million women have left the workforce. Given the nature of the shutdowns, this temporary aid that we provided last year and the Fed's swift actions, they prevented the worst from possible outcomes from occurring in this crisis. Now we have to deal with the divide, the uneven recovery that has occurred. And as we exit this pandemic, we need to find innovative solutions that support finding employment for these Americans and bring those who exited the labor force completely. We need to bring them back in. And the Fed must also focus on regulatory flexibility and provide flexibility to financial markets to ensure that we have a less choppy recovery. And indeed, Chairman Powell, there are new challenges and choppy waters ahead. And I'm grateful for your steady hand and pragmatic leadership at the Federal Reserve and for our economy and for our government. Thanks so much, and I yield back.
Thank you. I now recognize the chairman of the subcommittee on National Security, International Development, and Monetary Policy, the gentleman from Connecticut, Mr. Himes, for 1 minute.
Thank you, Madam Chair. And Chairman Powell, thank you for being here today. And let me echo our thanks for your incredible intervention and work in addressing the economic aspects of this pandemic. In 2008, the Federal Reserve took extraordinary actions, including the then controversial use of its emergency lending powers to rescue the financial sector. And the pandemic has shown us that the need for the Fed to engage in emergency intervention remains. When you were last testified before this committee in December, we discussed the wisdom or lack thereof of shutting down those emergency facilities before the pandemic was over. And then at the end of last year, we saw troubling signs on the horizon of elevated unemployment numbers and an uptick in business bankruptcy. So clearly we're not out of the woods. And if 2008 and 2020 have taught us anything, it is that crises happen and we need to prepare for them. Now, unlike in 2009, fiscal policy will be heavily deployed and our shoulder will be to the wheel. Nonetheless, the Federal Reserve is arguably the major player in our capital market. So I look forward to hearing from you today, Chairman, not just on where we are, but how this ends. How does it unwind? A look at page 43 of your monetary report shows the incredible interventions. And the question is, how does this unwind and where do we go from here? With that, I yield back.
Thank you. I now recognize the ranking member of the Subcommittee on National Security, International Development, and Monetary Policy, the gentleman from Arkansas, Mr. Hill, for 1 minute.
Thank you, Madam Chair, and I want to echo the comments from my friend and Chairman Himes of the subcommittee. We thank you, Chairman Powell, for the extraordinary actions of the Board of Governors during 2020 in monetary policy and in the extraordinary facilities and using 13.3. And we also commend the Congress and the executive branch in 2020 for their fiscal response, which gave us the resources we needed to fight the pandemic and get our economy to the point it is today to open. So I agree with Chairman Himes that now it's time to look on the other side of this pandemic as we vaccinate America, as we get our businesses open, as we see state and local governments having far in excess of the tax revenues that they anticipated and people getting back to work. How do we safely open this economy, get those jobs available for those 10 million Americans still seeking employment? And I look forward to your testimony today. I yield back, Madam Chair.
Thank you. I want to welcome to the committee our distinguished witness, Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Chair Powell has served on the Board of Governors since 2012 and as its chair since 2017. Chair Powell has testified before this committee, and I believe he does not need any further introduction. So without objection, your written statement will be made a part of the record. I want to remind members that Chair Powell has a hard stop and will be with us for 3 hours until 1 p.m. Eastern Time. Chair Powell, you are now recognized to present your oral testimony.
Thank you and good morning to all. Chairwoman Waters, Ranking Member McHenry, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we've taken forceful actions to provide support and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to households, businesses, and communities. Today, I will review the current economic situation before turning to monetary policy. The path of the economy continues to depend significantly on the course of the virus and the measures taken to control its spread. The resurgence in COVID-19 cases, hospitalizations, and deaths in recent months is causing great hardship for millions of Americans and is weighing on economic activity and job creation. Following a sharp rebound in economic activity last summer, momentum slowed substantially, with the weakness concentrated in the sectors most adversely affected by the resurgence of the virus. In recent weeks, the number of new cases and hospitalizations has been falling, and ongoing vaccinations offer hope for a return to more normal conditions later this year. However, the economic recovery remains uneven and far from complete, and the path ahead is highly uncertain. Household spending on services remains low, especially in sectors that typically require people to gather closely, including leisure and hospitality. In contrast, household spending on goods picked up encouragingly in January after moderating late last year. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due in part to unprecedented fiscal and monetary policy actions, which have provided essential support to many households, businesses, and communities. As with overall economic activity, the pace of improvement in the labor market has slowed. Over the 3 months ending in January, employment rose at an average monthly rate of only 29,000. Continued progress in many industries has been tempered by significant losses in industries such as leisure and hospitality, where the resurgence in the virus and increased social distancing have weighed further on activity. The unemployment rate remained elevated at 6.3% in January, and participation in the labor market is notably below pre-pandemic levels. Although there has been much progress in the labor market since the spring, millions of Americans remain out of work. As discussed in the February Monetary Policy Report, the economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers and for African Americans, Hispanics, and other minority groups. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. Following large declines in the spring, consumer prices partially rebounded over the rest of last year. However, for some of the sectors that have been most adversely affected by the pandemic, prices remain particularly soft. Overall, on a 12-month basis, inflation remains below our 2% longer-run objective. While we should not underestimate the challenges we currently face, developments point to an improved outlook for later this year. In particular, ongoing progress in vaccinations should help speed the return to normal activities. In the meantime, we should continue to follow the advice of health experts to observe social distancing measures and wear masks. I'll turn now to monetary policy. In the second half of last year, the Federal Open Market Committee completed our first ever public review of our monetary policy strategy, tools, and communication practices. We undertook this review because the U.S. economy has changed in ways that matter for monetary policy. The review's purpose was to identify improvements to our policy framework that could enhance our ability to achieve our maximum employment and price stability objectives. The review involved extensive outreach to a broad range of people and groups through a series of Fed Listens events. As described in the Monetary Policy Report, in August, the committee unanimously adopted its revised Statement on Longer-Run Goals and Monetary Policy Strategy. Our revised statement shares many features with its predecessor. For example, we have not changed our 2% longer-run inflation goal. However, we did make some key changes. Regarding our employment goal, we emphasize that maximum employment is a broad and inclusive goal. This change reflects our appreciation for the benefits of a strong labor market, particularly for low and moderate income communities. In addition, we state that our policy decisions will be informed by our assessments of shortfalls of employment from its maximum level, rather than by deviations from its maximum level. This change means that we will not tighten monetary policy solely in response to a strong labor market. Regarding our price stability goal, we state that we will seek to achieve inflation that averages 2% over time. This means that following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. With this change, we aim to keep longer run inflation expectations well anchored at our 2% goal. Well anchored inflation expectations enhance our ability to meet both our employment and inflation goals, particularly in the current low interest rate environment in which our main policy tool is likely to be more frequently constrained by the lower bound. We have implemented our new framework by forcefully deploying our policy tools. As noted in our January policy statement, we expect that it will be appropriate to maintain the current accommodative target range of the federal funds rate until labor market conditions have reached levels consistent with the committee's assessments of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, we will continue to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at their current pace, until substantial further progress has been made toward our goals. These purchases and the associated increase in the Federal Reserve's balance sheet have materially eased financial conditions and are providing substantial support to the economy. The economy is a long way from our employment and inflation goals, and it's likely to take some time for substantial further progress to be achieved. We will continue to clearly communicate our assessment of progress toward our goals well in advance of any change in the pace of purchases. Since the onset of the pandemic, the Federal Reserve has been taking actions to support more directly the flow of credit in the economy, deploying our emergency lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. Although the CARES Act facilities are no longer open to new activity, our other facilities remain in place. Finally, we understand that our actions affect households, businesses, and communities across the country. Everything we do is in service to our public mission. We're committed to using our full range of tools to support the economy and to help ensure that the recovery from this difficult period will be as robust as possible. Thank you. I will look forward to your questions.
Thank you, Chairman Powell. I now recognize myself for 5 minutes for questions. During our committee markup on February 10th, some members of our committee tried to suggest that further fiscal action was not needed because we are on a swift path to recovery. For example, it was noted that the unemployment rate in the United States is currently better than it had been for the first 5 years of the Obama administration. On that same day, you gave a speech that warned against this sort of top-line assessment of employment, noting that, quote, employment in January of this year was nearly 10 million below its February 2020 level, a greater shortfall than the worst of the Great Recession's aftermath, quote unquote. Chair Powell, do you believe our economy is in a healthier position right now than it was in 2014, several years into the recovery from the Great Recession?
I'm reluctant to make that comparison without thinking about it further. I will just, though, echo that we have 10 million fewer people working on payroll jobs than we had just 1 year ago today, and that the unemployment rate, the reported rate, is 6.3%. But if you include people who were in the labor force and indeed working in February and a couple of other adjustments, you get to almost a 10% unemployment rate. So there's a lot of slack in the labor market and a long way to go to maximum employment.
Thank you. In that same February 10th speech, you mentioned that, and let me quote, fully recognizing the benefits of a strong labor market will take continued support from both near-term policy and longer-run investments, quote unquote. Certainly, it will take a longer-run investments to achieve a true full employment economy that lifts workers' wages and finally closes the racial wealth gap. As Congress considers President Biden's American Rescue Plan, Some of my colleagues have said we should, quote, wait and see, quote, unquote, before spending more. Chair Powell, does the economy need additional fiscal support from Congress right now? Also, how critical is it for Congress to make longer run investments if we want to eliminate the racial wealth gap?
What I was really saying, Madam Chair, with that was that we've shown that we can, over the course of a long expansion, we can get to low levels of unemployment, and that the benefits to society, including particularly to lower moderate income people, are very substantial. We've shown that we can do that, but it's not really a great strategy to wait until the 8th or 9th year of an expansion to get those benefits. To really improve through the cycle, what I was saying in that set of remarks was that it'll take the private sector and it'll take investments from the public sector in, frankly, in the workforce, education, training, policies that support workforce participation, things like that. That's what I was really getting at there.
Response. And with that, I'm going to yield back my time, and I'm going to call on the gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee. You are now recognized for 5 minutes.
Well, thank you, Madam Chair. In fact, I think your workforce speech your labor market speech was a very important one for all of us to take note of. And this recovery is different than the recovery from the financial crisis. It took much longer for us to get to this rate of unemployment than it did post-financial crisis. And as I mentioned in my statement, that the chairman of the committee was kind enough to quote from, is that the labor market now is better than it was in President Obama's first term of office. So these recoveries are different. Now, also, you had a broad-based recovery that took almost a decade to come about with post-financial crisis. But right now, you have segments of the economy, like you mentioned in your statement, Chair Powell, about hospitality, that is lagging because of state shutdowns. But in your testimony, you mentioned the Fed's exit strategy is contingent on meeting the Fed's goals for economic recovery. So how close is the economy to meeting the Fed's goals, and what does that look like?
So what we've said is that we would be purchasing assets at least at the current pace until we see substantial further progress toward our goals. So that's actual progress. That's not forecast progress. So we would want to see that we moved, it is what it sounds like. We would like to see incoming actual data that show us moving closer to our goals, both for inflation and for employment. And that's what it'll take. And I agree there's an element of judgment in that, but we will be communicating as clearly as possible and as far in advance as possible how we perceive the path of progress toward those goals.
Okay, consistent with your mandate, consistent with the mandate.
Very much so.
So what does the labor market look like when the Fed has achieved this goal? What does the labor market look like?
So I think it's easier to say with liftoff. We've been very specific with liftoff. We said in liftoff we'd need to see labor market conditions that are consistent with maximum employment, inflation at 2%, and inflation expected to move moderately above 2% for some time. Those are the conditions for liftoff, and they're quite specific. We haven't tried to be that specific about the pace of asset purchases, and we've just said substantial further progress is what we said.
Okay. So Chair Powell, yesterday you also spoke about the digital dollar being a high priority for the Fed. I think this is a national security issue, an economic security issue for sure. You said you're committed to transparency as you look into the digital dollar. I think that's important. I think that's very important for our system of government. I think it's a very important thing for an open society. But let's get into a few specifics on that if we can. What can the public expect in terms of learning the details of this project going forward? And are some more details, are you able to share with us today
what we can expect from the Fed in this year, over the course of this year with the digital dollar project?
Yeah, so this is going to be an important year, and this is going to be the year in which we engage with the public pretty actively, including some public events that we're working on, which I'm not going to announce today, but there are things that we're working on. And it's the sense of this is not, here are the decisions we've made, what do you guys think? It's going to be, these are the trade-offs, they're both policy questions and there are technical questions that interrelate between those two, and they're very challenging questions. And so we're going to want to have a public dialogue about that with all of the interested constituencies. And that is the idea of what we're doing. In the meantime, we're working on the technical challenges and also collaborating with and sharing work with the other central banks around the world who are doing this. And, we will need, depending on what we do, we could well need legislative authorization for such a thing. That isn't clear until we see which way we're going. But so we will be engaging significantly with you and your colleagues on Capitol Hill as well.
Okay. So I think the project's vital. I think it's vital for American competitiveness. But I also, there's a fear that some want to use the digital dollar as a way to kill private sector innovation and in our banking system. Implementing modern monetary policy, modern monetary theory, for example, vis-a-vis Fed accounts. What do you say to folks hoping to exploit the digital dollar project in that way?
Well, one thing we need to be very mindful about is that we have a functioning financial system and a banking system and capital markets which intermediate between savers and borrowers, and they're the best markets and I would say the strongest banks in the world. We need to be careful with our design of the digital dollar that we don't create something that will undermine that very healthy market-based function. That's one thing,
okay,
for sure.
Yeah. Now, final question here. You mentioned the labor market. We talked about the labor markets. As far as the fiscal side of the house, what are the things that we should be doing? What are the biggest challenges to getting people back to work?
Well, the single biggest, as you well know, unemployment and low activity is concentrated in that reasonably broad sector of the economy, in the service sector, where people gather closely together. Travel and entertainment, leisure, that whole hotels, those sorts of things. The single most important policy to getting those sectors reopened and getting people back to work, of course, is bringing the pandemic to a decisive end as soon as possible. And we're on the path to that, but we haven't done it yet. So I think it's important that we do quite decisively this year.
Thank you. Thank you, Chair Powell. Thanks for your leadership.
Ms. Velasquez, who is also the chair of the Committee on Small Business, is now recognized for 5 minutes.
Thank you, Chairwoman. Chairman Powell, I heard you speak about the changes in the FOMC's monetary policy framework in your opening statement. It is clear that the pandemic has had an outside impact on women, minorities, and younger workers. How will the changes in the FOMC's monetary policy framework benefit workers in these groups?
So what we learned in the course of the last expansion was that we could have an unemployment at historically low levels without seeing troubling inflation arise. So we took that on board in creating our new framework. And as I mentioned in my remarks, that means that we won't tighten monetary policy just because of a strong labor market. We want to see either inflation moving up in a troubling way or other risks to the achievement of our goals. And that puts us in a place where we can have low levels of unemployment again. And when we get to those low levels, we see that they do benefit low and moderate income communities and women and minorities more than others who tend to benefit earlier in the expansion. So that plus what we said about maximum employment being a broad and inclusive goal, I think what I would point to.
Very good. Thank you. Chairman Powell, in May 2020, the OCC finalized a rule substantially revising the Community Reinvestment Act, which the Fed and the FDIC did not sign onto. In September 2020, the Fed proposed its own update to the CRA. With the change in the administration, do you expect the Fed to re-engage with the OCC and the FDIC on CRA rulemaking? And do you think there is an opportunity for a harmonized rule amongst all three agencies?
I think there is an opportunity for a harmonized rule among the three agencies, and we are engaged, have been engaged, and continue to be engaged with the FDIC and the OCC, and we're working on that very thing.
Do you have a timeline?
I think we're just getting started.
Okay.
There will be a new comptroller, but nonetheless, we're working on it. And by the way, it will be one that has broad support among the community of intended beneficiaries, which was always the Fed's test and my test for what it would take for the Fed to support reform of CRA.
Glad to hear that, especially at this time when underserved communities, minority and female businesses and all that have been impacted by this pandemic. And CRA is a way to lift up communities of color, particularly. Chairman Powell, last week, Governor Brainerd gave a speech on the role of financial institutions in tackling the climate challenge. In her speech, she stated, and I quote, "Climate change is already imposing substantial economic costs on the economy and is projected to have a profound effect on the economy at home and abroad." Would you agree with her statement, and can you give some examples of how you see that to be true?
Well, I think climate change is a very important issue, and if you'll allow me, I will start by saying that the nation's policy on climate change really needs to be set in the first instance by you, elected representatives in the House and Senate, and then by the administration through the agencies that Congress has created. Our role is really that of assuring that we are using our powers to carry out our mandate in supervising financial institutions to make sure that they're resilient to all risks, including that of climate change. That's what we're doing.
And can you explain the steps the Fed will be taking over the next 18 to 24 months to ensure the financial system can deal with the future financial and economic risks posed by climate change?
Yes, so we're doing right now a great deal of outreach and research and consultation. And by the way, the larger and medium-sized banks are doing the same thing. It is really time to have this, to do this work and to try to understand. Climate change is a longer run issue to deal with, and you will see that the financial institutions themselves are very focused on understanding how it will over time affect their business model. We're looking at the same thing from the standpoint of a regulator and supervisor. So research and basic work to lay out a framework, which will take some time, but it is time for us to do that.
Thank you. I yield back.
Thank you. The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
Thank you, Madam Chairwoman and Chairman Powell. It's good to see you again. Thank you for being here today. Thank you for all that you and the Fed have done during this unprecedented pandemic. Under the Fed's average inflation targeting, you are looking for inflation to be, and I quote, moderately above 2% for some time to make up for undershooting inflation in the past. What does moderately above 2% for some time mean specifically? And why do we believe this is achievable if the FOMC's 3-year projections for quite some time now have been forecasting inflation, in fact, of 2% or less?
So on the first part, what does moderately mean? We don't have a formula, and we're not going to have a formula. The sense of it, though, is that we want inflation to average 2% over time. And the reason we want that is that we want inflation expectations to be anchored right at 2% and not somewhat below 2%, which is arguably the case now. That's really how we're looking at it. In terms of can we get there, I'm confident that we can and that we will, and we are committed to using our tools to achieving that. The 3-year time frame is actually an arbitrary 3-year time frame chosen by us. And we're just being honest about the challenge. We live in a time where there's significant disinflationary pressures around the world, and we're essentially all major advanced economy central banks have struggled to get to 2%. We believe we can do it. Believe we will do it. It may take more than 3 years, but we'll update that every quarter. We update that assessment, and we'll see how that goes.
Thank you, Chairman Powell. I know you were asked a number of times by my colleagues in the Senate yesterday whether the Fed intends to extend the exclusion of low-risk assets such as Treasuries and reserve balances from the supplementary leverage ratio. I strongly supported the agency's decision nearly a year ago to make this exclusion in recognition, I think, of the fact that banks were receiving just an unprecedented amount of new deposits, largely as a result of the Fed's actions that continue to put pressure on leverage ratios. You indicated, sir, yesterday that the Fed is still considering whether or not to provide an extension. Do you agree that the exclusion proved to be an important tool to preserve liquidity in the Treasury market?
Yes, I do agree to that. But I mean, we're just looking at this. I don't really have anything for you on that decision. But I didn't have anything yesterday, as you pointed out. So we're looking at that, and we know when the deadline is, and we're working on that, and we'll come forth with something relatively soon.
Well, I hope it's relatively soon, Mr. Chairman, because given that we're still considering new stimulus and other accommodations to continue economic recovery, I'm concerned, and I'm wondering if you are concerned about that arbitrarily removing the exclusion on March 31 could put additional pressure on the Treasury market. I mean, making sure that the SLR is extended, I think, is very, very important as we continue this recovery. And as I said, as further stimulus actions are considered and put into law. March 31 is nearly upon us, Mr. Chairman.
Yes, it is.
Oh, come on. Surely you can talk to us a little bit more about how important that was over the past year in terms of our banking industry and to keep liquidity in the market, given the large number of deposits that were extended to our banking community.
I'm just going to say that we're having discussions on it right now and internally here, and I really don't want to go any further than that. I'm sorry, but we're making a decision. We're considering it, and when we have a decision, we'll come forward. I'm sorry.
I respect that, and I look forward to that decision. And Madam Chairman, I yield back. Thank you.
Thank you. The gentleman from California, Mr. Sherman, who is also the chair of the subcommittee on investor protection, entrepreneurship, and capital markets, is now recognized for 5 minutes.
Thank you. Mr. Chairman, it's good to hear about your Fed Listens events, but I assure you your best Fed Listens event is right here today. You will not find 50 people in better touch and more representative of the 320 million Americans. I've grown old serving on this committee, and I've seen your predecessor come here, and Republicans attack them for what they regarded as a too expansionary monetary policy, whether the expansionary system be the traditional or the relatively newfangled quantitative easing. It's good for me to live long enough to see that many of the Republicans are moving in our direction toward the need for a somewhat more expansionary monetary policy. And I would hope that you would be looking at 2.25% rather than 2% as your target. I also commend you for the quantitative easing. it has allowed you to remit to the federal government 50 to $100 billion in each of the last several years. And so those who criticize your big balance sheet have been unwilling to identify which taxes they would raise in order to make up for that lost revenue. Also, your quantitative easing big balance sheet approach is the only tool you have to influence long-term interest rates, which I think are much more important to our economy, since you have to borrow long-term to build a factory or build a business. And I prefer monetary policy to an expansionary fiscal policy, because all of your tools reduce the federal deficit, and all of our tools increase the long-term federal debt. Want to focus your attention on LIBOR. It now appears as if the LIBOR index will continue to be published till June of 2023. It's almost disappointing to get a reprieve, and that it will reduce the pressure on us to actually solve this problem. But it does give us more time. And there is, of course, the Alternative Reference Rates Committee, ARC, and we have legislation to facilitate how to deal with what will be $2 trillion of existing contracts that don't have backup language. I wonder if you can confirm for me, in your view, is it necessary to have federal legislation to have a smooth transition after June 2023, when LIBOR is no longer published?
Yes, we think it will be. As you know, many LIBOR contracts are going to run off before then, but there'll be a hard tail, as we say, and we do think federal legislation is the best answer.
And there are those who think that that the private sector can just invent a synthetic LIBOR and that would solve the problem. Is that as good a solution as federal legislation?
No, federal legislation creating a path for a backup would be the best solution, we think.
Thank you. Now I want to move to something that we've talked about before, and that some will regard as a small issue, and that is the system for avoiding wire fraud. When we've talked about this earlier this month, where usually it's somebody trying to buy a home, the first time ever, when they'll remit $10, $20, $30, $50,000 for the down payment. It's their life savings. And they're tricked into wiring the money to the wrong account number, and they lose it forever. Now you're developing the new FedNow system, and your bureaucrats have told us that they don't want to engineer that system to avoid this tragedy that occurred, as I said, affecting $150 million just last year. That they don't want to do the really simple thing of just saying that when you remit money, you identify not only the account number you're sending it to, but the name of the person you're sending it to. And I know your bureaucrats will tell you they don't want to do it. I wonder whether you'll go back to your agency and get personally involved and push them to avoid this tragedy. I don't think your successor should have to, face people at the next Fed Listen session, maybe 10 years from now, who have lost their homes as a result of this. Can you commit to getting personally involved and having a system that will hopefully protect homeowners or home buyers?
So I think, as you know, we've looked carefully at this and concluded that payee matching is not the best way to do it, and there are just problems in the U.S. system, but we have other ways to do it well. I'd be happy to go back and revisit that, though.
If there's another way, let me know what it is, because your staff just tells me they don't want to.
The gentleman's time has expired. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair. And Chairman Powell, you know I have a tendency to focus on those things that affect my people back home up and down Main Street and across the 3rd District of Oklahoma. So let's discuss for a moment. When you were last before the committee in June, you noted that the U.S. banking system has been a source of strength during the pandemic. The Fed's monetary policy report released on February 19 reaffirmed this point, stating that institutions at the core of the financial services system remain resilient. Do you continue to believe that banks are a source of strength? And will you elaborate both on what that means for the economy and for banks' abilities to lend Yes, absorb losses potentially too, and provide liquidity in distressed markets.
Yeah, so we've, like, you know, we spent, and the bank spent 10 years in a strengthening process, higher capital, better risk management, higher liquidity, all of those things. And then we received a world historical sized shock in the form of the pandemic. And I think, you know, essentially close to a year into it, almost exactly a year into it, we see so far, what we see is that our banks have held up quite well. And their capital, the big banks' capital has actually increased over the course of the last year, while they've also taken 100 billion plus worth of reserves against losses. And so they are able to keep lending. They're not a source of weakness. At the beginning of the pandemic, they were very important because they did absorb that huge flow of deposits, and they made all of those loans as companies pulled down their lines of credit. Now, those were paid back early on, but at the very beginning, when it mattered a lot, they were a source of strength. So I think all of that is right. We've always got to continue to be vigilant on those things, but a first draft of history is that the banks are strong. And I would say the same for small and medium-sized banks as well, have generally held up well. There are going to be issues, and as we come out of this, there are going to be businesses that fail and there will be losses, but it's quite different, a very, very different situation than we had after the global financial crisis.
Absolutely. And Mr. Chairman, let's discuss for a moment a topic that's very important, not only to me, but my friends in the majority on the Financial Services Committee. The national unbanked rate has been falling steadily for the past decade, and since the last calculated in 2019 sets at about 5.4%. Still, this represents more than 7 million U.S. households without a checking or savings account. Unfortunately, the COVID-19 pandemic is likely to contribute to an increase in the rate of unbanked households. Chairman, what would you suggest to reduce the adverse impact on the unbanked and underbanked in the aftermath of the pandemic to ensure that no one is left out of the economic recovery?
You know, I think it's a serious problem to address. You know, we tend to address it through our community affairs and efforts to make sure that, you know, fair lending policies and things like that. I also think that there's more that Congress can do, I'm sure, to assure that people have, you know, education around financial matters. And the other piece of it is, you know, there are people at the lower end of the income spectrum who are living hand to mouth. We need a strong recovery. We need continued support for monetary policy, and we'll be providing that as well.
One last question, Chairman, and it impacts the ability of every Main Street to function. According to FDA, the United States administered more than 63 million doses of COVID-19 vaccine. Chairman Powell, can you expand on how important to the economic recovery, or how dependent the recovery is on ramping up that manufacturing and distribution?
Yes, this is the weakness we see in our economy now is unusually concentrated in a set of industries that involve people getting really close together. Hotels, restaurants, travel, entertainment, all those places. And that's millions of people who aren't working, and businesses that may have been in business for generations going out of businesses. That's what that is. And the way to get after that is through by successfully, decisively bringing the pandemic to an end as soon as possible. That's the single best growth and economic and prosperity creating measure that any of us can undertake. And that, you know, that is the vaccination. It's continuing to observe social distancing and wearing masks. And hopefully we're on that road now. And you know, if we are, we're going to see, you know, there's grounds for optimism in the second half of the year for the economy.
The gentleman's time has expired. The gentleman from Texas, Mr. Green, who is also the chair of the subcommittee on oversight and investigations, is now recognized for 5 minutes.
Thank you very much, Madam Chair, and I thank the witness for appearing. I'm always honored to have him here before the committee. My question has to do with the State Small Business Credit Initiative. This is an initiative that was started under a Republican administration. It has served us exceedingly well. And the chairwoman, with her insight and foresight, has expanded this program to make sure that it covers women and people of color to a greater extent. We're talking about having this initiative be funded with $10 billion, and this is in the COVID package. And this $10 billion can drive up to $100 billion of private sector investments in these small businesses. States would be required to submit a plan, as well as other jurisdictions, on how expeditiously these funds can be delivered to help small businesses respond to and recover from the pandemic. A plan to encourage participation of MDIs, Minority Depository Institutions, as well as CDFIs, Community Development Financial Institutions, would also be a part of this. Mr. Chairman, my question to you is simply this. How important is it that small businesses receive these capital investments? They sometimes find it exceedingly difficult to acquire funds of this type, the type that we have in this package. How important is it that these funds during this pandemic get to these small businesses?
Well, small businesses are under a lot of pressure in this at the current time, more so than many of the larger businesses that had resources to get through this. I would say MDIs and CDFIs are very important channels for reaching them. It's not appropriate for me to take a position on this particular provision and its inclusion in the in legislation. But I would just say that it is important for small businesses, and you mentioned MDIs and CDFIs. We, as you know, we work very closely with those organizations and think highly of the contribution they make to our economy.
Yes, sir, and I concur with what you said about working closely with them. I happen to be aware of some of your good works. The community banks, as you know, I'm very much concerned about them, and some of them are on the margins. And this type of assistance to some of these smaller banks can be of great help to them. I don't want you to comment on a specific bank or specific banks in general, but I am concerned about the need to maintain these institutions that have a niche. They have a clientele that somehow and sometimes will not be met. Their needs won't be met if they don't have these institutions that are in the communities. Have you found that it's good to have these institutions in these communities where the need is not always met?
Yes, I mean, we think community banks are a very important part of the fabric of our society, and we see them under longer term secular pressures. They've been declining, and we don't want to do anything that adds to that through regulatory burden. And actually, we've got a subcommittee. We have a community banker on the board of governors, and we try to do everything we can to not be part of the problem, because people are leaving small towns and moving to cities and things like that, and that is putting pressure on rural community banks. But overall, they know their communities, and we want them to operate safely and soundly and successfully in their communities.
Well, thank you very much. I have very little time left, so what I would like to do is simply acknowledge the chairwoman for helping us to get this $10 billion into the COVID package. Ms. Beatty also helped us to modify it along with one of my Republican colleagues so that the very small businesses will get some help. There are small businesses, and then there are very small businesses, and we don't want to leave any of them behind. So, Madam Chair, I thank you very much for the opportunity to ask these questions. I yield back.
Thank you very much, and I appreciate your comments. I will now recognize the gentleman from Florida, Mr. Posey, for 5 minutes.
Well, thank you very much, Madam Chairwoman. I'm pleased that we have this opportunity to hear Chairman Powell's semi-annual report on the state of monetary policy. We've all shared quite a year since February 2020 hearing, when the virus was just breaking over the horizon. And we continue to be motivated and preoccupied with the horrendous, unprecedented event. through no fault of their own, our constituent families and their small businesses experienced perhaps the worst economic downturn in our history and theirs. It was absolutely right to address the suffering of our workers and their families, and we can be proud of the bipartisan response in the public laws we passed, such as the CARES Act. We are now in a period of somewhat less consensus about the next thing to do. On the one hand, the administration and others are saying that we need to go big on spending, and this week the House is slated to vote on their $1.9 trillion big plan. Notably, the big plan spends money with a wide scope, and of course, the money will likely all need to be borrowed. Others are saying that in many sectors, the economy is doing well, but that in other sectors like hotels, restaurants, and tourism, workers and businesses are still suffering. Now, thus, many people say that the targeted relief will be a better approach and save us borrowing to the tune of $1.9 trillion. And I associate myself with the targeted approach, by the way. Mr. Chairman, I'm wondering, you've been urging that monetary policy can't fully restore the economy, and you've made that clear today, and that fiscal policy must play an essential role. Just after the Federal Markets Open Committee meeting on January 29th of 2020, you said, quote, "The labor market continues to perform well. The labor market continues to be strong. We see strong job creation. We see low unemployment. Very importantly, we see labor force participation continuing to move up." End of quote. Fiscal policy includes taxes as well as spending. Things look really good in January of 2020. In fact, far better than, say, 4 years earlier. Given your knowledge of fiscal policy, did Fed research suggest that the reduction of personal taxes and corporate tax and reductions in regulation work to reduce unemployment to historic lows, generally and among many diverse groups? I'm not able to get the answer here.
The longest expansion in our recorded history actually began in 2009 and ended last year, as you point out, with the arrival of the pandemic. The labor market improved steadily and then gathered strength. Actually, the peak job creation year in that expansion was 2015. We did reach low levels of unemployment, and that includes particularly for minorities. And there was just a whole lot to like about where the labor market was last year. I'll just say that many, many factors contributed to that long expansion, and I don't know any way to unscramble the omelet on that.
Well, thank you. What does the apparent effectiveness of the fiscal policy of low income and corporate taxes and the policy of constrained regulation that started in 2017 teach us about the potential effects of increasing taxes and regulation as we try to recover from the pandemic?
It's not for me to comment on fiscal policy. We have a specific role and specific tools, and I'm going to stick to that.
So you don't have any opinion of what lower taxes and less regulations do to help an economy recover from the pandemic?
I think those are exactly the questions for elected officials. Those are right over home plate for you. You've given us a specific job, maximum employment and price stability. We use our tools, and we don't get involved in what are political judgments around fiscal policy. That's really for you and the administration.
All right, I just thought it was something that every person would have some opinion of, one way or the other. I see my time has expired, Madam Chairman. I yield back. Thank you.
Thank you very much. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes. We'll move on if he is not available. The gentleman from Colorado, Mr. President. which also the on consumer protection and financial institutions has been recognized for performance.
Okay, thank you, Madam Chair. Mr. Chairman, thanks for being here. Thanks for your service, especially during this last year. So I'm going to ask you sort of 4 different areas. First is going to be on that supplemental leverage ratio and see if I can get an answer out of you that Ms. Wagner didn't. Second will be on state and local governments and support for them. Third will be on bubbles that you may see existing. And the fourth will be on credit cards. So hopefully I can get to all of these. Last year in April, the Federal Reserve, the FDIC, eased capital requirements for financial institutions by allowing firms to exclude treasuries, U.S. treasuries, and deposits held at the Federal Reserve from the supplementary leverage ratio, the SLR. This was a welcome policy which helped stabilize the treasuries market and gave flexibility to financial institutions in a time of uncertainty. And I know with respect to your answers to Ms. Wagner as well as to the Senate, you all are sort of deciding what you want to do in that area, but I'm going to ask you a more general question. If regulators do not extend the SLR relief, do you think the additional capital requirements will have a meaningful effect on the bank's ability to lend into the recovery?
So I'm just going to say again, if I start answering these questions and get pulled down that slope, you know where I'm going to wind up. So I'm really, that's something that's under consideration right now, and I'm just going to have to leave it at that.
All right, so let's take the flip side, see if I can get you to answer this. I know that a number of institutions are interested in expanding their dividend program. Is the Federal Reserve considering allowing banks to offer more dividends?
So we don't have a decision on that. That's another thing that we will be looking at as well. What's been happening is we've been restricting banks from share repurchases and dividends, and as a result of that, they've actually built capital. And as time goes on, we'll be looking at that on a quarter-by-quarter basis, and that's coming up, but it's not today's decision.
Well, I know Ms. Wagner is going to feel good that you didn't answer either one of us, so I appreciate that, and I'm sure she does too. Let's turn to state and local governments, and on pages 24 and 25 of your report, and it's graphs 27 and 28, there appears to be a precipitous drop-off in revenues and taxes collected and employment at the state and local government levels. Do you, in the legislation that we're considering, there is substantial assistance to state and local governments. Is this one of the areas of the economy that the Fed has been concerned about?
Well, we were quite concerned at the beginning because of the example of the global financial crisis, where weak revenues led to really weight on the recovery through some years. I'm not going to comment directly on whether on the proposal that's under consideration right now, right in front of you this week. So what we see is that revenues have performed better than expected. They're about flat overall. Some states they're down a lot. Other states they're actually up. So we have a good picture of revenues. We have a picture of employment, and employment is down 1.3 million or so. A lot of that's education, which means people who work in schools, and that should be addressed by the reopening of the schools. The thing we don't have a great picture of, and you may be able to get it, is more the expenses. What are the one-time COVID-related expenses? So it's a complicated picture, and there's differences across the states. States have very different positions on this. So, and I know it's a question you're considering, and I'm sure your experts are focused on all of it.
Well, in Colorado, and looking at your report, I mean, obviously my state has a lot of leisure industry, tourism, and energy production. And it's hit us particularly hard in terms of employment and revenues. So last question. Do you see any bubbles that are of concern to you, whether it's stock valuations or real estate? Because on page 30, and I know my time is about to expire, you say that you see real estate prices are at all-time highs, but vacancy rates are at some all-time highs as well.
So your time is actually up according to my clock, but will I have time to answer this, Madam Chair?
Boston's on mute. Go ahead and answer.
Okay, so I can't answer that in 10 seconds, right? So we have a broad framework for financial stability, one of the 4 pillars of which is asset prices. And there are some asset prices that are elevated by some measures, yes. Other aspects of the financial stability framework, leverage in the financial system is moderate. Funding risk is moderate. I would say leverage in the non-financial system has gone up a bit because of the pandemic.
All right,
very mixed picture.
All right, I thank you for your answers. I thank for the chair for extra time. I yield back.
Thank you. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair, and welcome, Chairman Powell. Great to see you again, and thank you for your great leadership during the pandemic and this past year. It's been a trying time for all of us, and I think you've done a good job of steering the Fed through this storm, as the ranking member talked about it a while ago. One of the things that's concerning to me is I saw an article in a recent paper here with regards to the greening of the banking system, and I think my good friend Congressman Barr of Kentucky and I, he headlined a letter to the Fed, and I was one of other 45 members who signed on to it with regards to the Fed's including climate stuff into their stress tests. And while I understand the need for that to an extent, it certainly is concerning. It raises some flags for me from the standpoint that in an article here, it was talking, excuse me, a gentleman by the name of Ike Brannon, who's an economist and president of Capital Policy Analytics. He was talking about the stress test, and he said that it's a long-term goal of many who advocated that the Fed take this step. But he says, I think they have designs that go beyond climate change. Creating a system whereby the government can use its financial regulatory power to direct the economy away from businesses and industries it disapproves of is very much a goal of many Democrats in Congress and the administration. Mr. Chairman, that sounds an awful lot like choke point to me. Operation Choke Point was something that we put the dagger in the heart of several years ago. And to resurrect that, to use climate change as an excuse to go after businesses who are doing legal business in a legal way, producing products and services we need as an economy is wrong. And I'm just wondering where you stand on that. Mr. Chairman.
Sorry. First, let me say that the climate stress scenarios are completely different from the stress tests. It's not the same thing at all. And but you really asked about a different question. Sorry, which was just in 2 seconds, what was the question you did ask?
Well, basically, it's about whether you're weaponizing the regulatory system to do choke point stuff again. If on business, on banks that do not necessarily comply with what your climate agenda may be.
So we're not climate policy makers. Climate policy makers are democratically elected people, and those they delegate that authority to. So we're not thinking of it that way. We, as you know, as an institution, we've had a long-held reluctance, resistance, and unwillingness really to engage in the allocation of credit. We think that is for the private sector, and if Congress wants to allocate credit in particular ways, that's fine. We don't want to get involved in that, and it's not something we're looking to do. What we're doing is well, go ahead. I'll let you go.
Well, I would just make the point that we found during the Obama administration that Operation Choke Point was alive and well. It was instituted by them. It was carried out by them, and we tried to get rid of it during this past administration. So it's something that's there. It's something that we talked about a lot. But let me move on. With regards to the executive orders that are coming out of the administration right now, they're very concerning to me from the standpoint that by taking one of the executive orders off the books that President Trump put in place, that take 2 rules off the books for every one that he puts on, it's a signal to me that look out, here come the rules and regulations. And another one that they took off the books was one with regards to guidance, which is extremely important to me. FSOC, which you're a member of, came out and supported the overall rule of not enforcing guidance and had a policy-wide FSOC policy with regards to enforcement of that guidance. The administration came out with an executive order that said they're not going to enforce guidance across the entire administration. Now that issue is, that executive order has been rescinded as well. So my question to you is, I guess, do you see yourself relaxing some of the constraints that were in place as a result of the rule with regards to guidance? Is this something you're thinking about, or are you going to continue to comply with the rule that says you're not going to enforce guidance?
We don't enforce guidance, and that's not something we're changing.
Okay. It's concerning to me in that respect because it's something that I think we've worked hard to push out. And now we have a new regulator at CPB, which is looks like Richard Cordray 2.0, but we'll wait and see once that comes out.
Thank you. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for this hearing. I look forward to this every year. Mr. Chairman, thank you for being with us today. Although I want to do the majority of my discussion with you about CRA, I've got to go to this New York Times article and ask what is your response to the article, which essentially is suggesting that particularly as it relates to economists, that African Americans are not even represented at the level they are in any other particular area. I think that the quote was in the article, Black people are less represented within the Fed than they are in the field as a whole. So can you give us your take on the article? Is it accurate? Is it fair? What do you think?
You know, I'm not the one to judge whether it's accurate or fair. It's not whether it's fair. I would say we're not where we want to be on this. We do work hard at it. It's something that I'm personally committed with, and that all the leadership of the Fed and the whole Fed is very focused on strengthening our workforce diversity. We are out there aggressively recruiting, both encouraging young minority kids to get interested in economics. I do that. I meet with people every year on that. Also, we go to historically Black and Hispanic colleges to encourage. And when we find candidates, we recruit them hard. And it's challenging. And I would just say that we're doing a lot, and I'd be happy to come up and share it with you in a lot of detail. But the results are not where we'd like them to be, and we're wide open to ideas, suggestions as well, and we'll just keep working on it. And believe me, we're working hard at it.
Yeah, and I appreciate your candor on that. And I know for the Kansas City Fed, for example, annually they were bringing up Black students from Kansas City to Washington, trying to give them this experience in hopes that some of them would eventually want to do this. So I don't think that there has been any intentionality on your part. I'm just trying to figure out what we can do with you to be helpful, and maybe we can talk about that at a later point. Because I'm very concerned about the CRA issue. It came about in 1977, I think, or somewhere about that time. The initial charge, of course, was that the lending institutions, banking institutions were not giving attention to certain areas of the city, and they were not investing, and in some cases, not even depositing in those areas. So we have CRA right now, but I'm having difficulty. And I intended to talk to the chair about this earlier. I haven't didn't do it. I'm not sure that I can put my fingers on CRA projects or you know, or what they're doing in my local community. Maybe you know, they're more visible elsewhere. But are you convinced that CRA is where it ought to be, or should we have some 21st century changes in CRA? Because maybe, as our chair has said, and I say everywhere I go, the one of the issues we have in that same area is the lack of affordable housing. And so, you know, maybe it's time to look at a new way in which we can do CRA where it will be more effective and more visible.
Well, we place a very high priority on CRA. We think it's an incredibly important law, and we want it to be as effective as it can possibly be. And that's really what's behind the effort that we put into our proposal. We took a tremendous amount of input from, you know, from the groups who are intended to benefit from it, but also from the financial institutions who are also eager to, you know, to make their communities better. So, so that's very much the spirit in which we approach this project. If you have particular ideas, we'd love to hear them. So,
well, you know, regulatory agencies having a coordinated approach on CRA, and then maybe that's something that we have to talk about when we have time, because I think my time is running out. Madam Chair, thank you very much.
Thank you very much. The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair and Mr. Chairman. Glad you are here. I want to do a quick, just sort of technical check. There was a Washington Post article, a number of other articles talking about your time yesterday at the Senate. You talked about the 6.3% January unemployment, but that is closer to 10. Are you talking about the U6 number that is typically published by Department of Labor?
no, I wasn't, although it's not dissimilar. I was really saying that you know that if you haven't looked for a job in the last 4 weeks, then you're not considered unemployed. You're considered out of the labor force. Yep. So a whole bunch of people, a couple million people, dropped out of the labor force who were actually working, and they're not counted as unemployed. But I'm saying for purposes of this exercise, we should think of them as unemployed because they want to come back in.
Which I talked about extensively during the recovery. You didn't need to look at the unemployment level. You needed to look at the U6 number that the Department of Labor publishes. So
same idea.
Okay. All right. I think it's been explored, and you've acknowledged there is a completely uneven recovery happening in the economy. You and I have had a chance to talk about this in person as well. My district, which is an ag producer, I'm a home to Gerber Baby Foods. I've got a Heinz pickle plant. I've got Tyson Foods. I've got a number of specialty crops, blueberries, pickles, asparagus, et cetera. We're heavily agriculture, but we're also a heavy manufacturing district. But the third leg of our economic stool throughout Michigan, but especially concentrated in my district, is in that hospitality and tourism area. Housing fully recovered, as you had said, manufacturing, at least in our area, especially automotive, office furniture, those types of things, mining, others, manufacturing, very, very strong. What we are seeing, though, is a desperation in that hospitality area. And I guess it begs the question of whether the economy is actually in crisis writ large, or do we have pockets of crisis within a reasonably healthy economy? I want to give you a quick second to answer that. And then I want to move on to the real estate question that my friend, Mr. Perlmutter, was talking about. I want to explore that a little bit more.
So that the losses and the damage are concentrated in those industries that we talked about, that you mentioned. It's also the case, though, that a number of other industries are short of where they would be if there hadn't been a pandemic. So there's a broad amount of slack around, but it's really concentrated in those industries, which are, by the way, a big chunk of people. There are 10 million people fewer people
Yeah,
working, right? So it's a big
Huge,
number.
huge. I will note a lot of that is in Michigan, we have 25% occupancy allowed for a restaurant, for example. Theaters are very sparsely populated. You can't do those types of things. So at some point or another, this isn't a federal issue. It is a local and state issue as to allowing those concentrations of people, as you know. Commercial real estate. Can you elaborate a little bit more what's happening in that commercial real estate space, especially? We're seeing very strong residential, but commercial space is what Mr. Perlmutter was going after.
Significant challenges for hotels, clearly, but also for office. And, you know, the question is going to be how quickly can we get the pandemic over with and find out what equilibrium demand is going to be after that. People will still be staying at hotels, they'll be traveling, but you know, office space, certainly in major cities, there may be more commuting. We don't know.
I think there's more hiccup within that business space, both business traveling as well as what work is going to look like. And I've got just a minute here, but one of the things I guess I'm getting at is there's a concern a lot of us have with this additional stimulus that's going to be getting put into the economy. Certainly the stimulus that the Fed has been providing. I want to know, is there a risk of overheating the economy writ large while by using these broad monetary tools and others to address underperformance in select areas such as hospitality and some of these more concentrated? In other words, are we creating a bubble in some of these other areas?
You know, so our tools work in the aggregate, as you know, at the economy-wide level, and I would just say that we do expect inflation to move up, both because of base effects, as I discussed yesterday, and also because we could have a surge in spending as the economy reopens. We don't expect that to be a persistent, longer-term force. So while you could see prices move up, that's a different thing from persistent high inflation, which we do not expect. And if we do get it, then we have the tools to deal with it, and we'll use them.
Thank you. The gentleman's time has expired. The gentleman from Connecticut, Mr. Himes, who is also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell. As you've noticed, we have a robust debate going on around here about a major fiscal package. I'm certainly influenced by what I saw 10 years ago when our fiscal response to another financial crisis was, in my opinion, deeply inadequate. I also believe that when thousands of Americans are dying every week still, it is far better to risk doing too much than to risk doing too little. Nonetheless, the concerns that are being raised about inflation, I think, are valid and need to be considered. I remember the early 80s, late 70s, when inflation destroyed the savings of the middle class and reduced confidence in the economy, and it was very, very painful getting out of that. So my question for you, Mr. Chairman, is do you believe that there is some combination of expansionary fiscal and monetary policy that could lead to inflation? And I have two very specific questions. What to you are the leading indicators of that? And the other specific question is there some combination of challenged supply chains and surging demand that leads to an unhealthy level of inflationary pressure? And are you seeing any of those indicators at concerning levels at the moment?
You know, so we know that inflation dynamics evolve over time, but they don't tend to change overnight. And so we've had, and I remember well, I was in college during the 1970s. I remember well high inflation and this feeling of powerlessness on the part of anyone to deal with it until finally Paul Volcker did exactly that. And we've been in a low inflation, disinflationary mode ever since. So what I see is an economy where there's still a great deal of slack. I see the prospect of really significant progress as we put the pandemic behind us. As we see that data, we've got in place guidance that tells markets clearly when we will begin to taper asset purchases and when we will begin to raise interest rates when the economy, in that case, when the expansion is very far advanced. So we have our tools, we have them in place, And we think that this is the appropriate policy stance. As I mentioned, inflation, it's something I remember well, and I'm very familiar with the history of the 1960s.
I guess, Mr. Chairman, sorry to interrupt. I guess my question is more about, I know where you are today, but I'm curious about what you consider the leading indicators, and in particular, whether you're concerned about challenged supply chains, because of course they are challenged.
So those are things like supply chains are, unless they're permanently challenged, there could be take an example of the chips issue with microchips issue right now. The automobile industry is having a hard time getting it. So this is a significant economic issue. And if there's a shortage of cars, then prices of cars might go up. That doesn't necessarily lead to inflation, because inflation is a process that repeats itself year on year on year. So supply chain issues, as we get back up to full economic activity, you could hit supply chain constraints along the way, but that doesn't necessarily mean you will have a higher inflationary process if the Fed maintains its credibility and if inflation expectations remain anchored, which they weren't in the 1960s.
Thanks, Mr. Chairman. I have one more question, again, sort of rooted in the experience of 10 years ago. As somebody who was closely involved in the writing of Dodd-Frank, it's very gratifying to hear you say, I think you said that the banking sector has held up quite well. I remember 11 years ago, we were promised by some that Dodd-Frank was going to crush the American capital markets. We were promised by others that at the first sign of a stiff breeze, it would all come apart, and son of a gun, it held up pretty well. But I am always concerned about the risk that we don't see. So getting off of monetary policy, issuance volume in the high yield market, and I know these are a little bit outside of the banking sector, but SPACs, in my remaining 40 seconds, give me a sense of what is concerning to you that could challenge the stability of the financial sector.
Well, our policy is accommodative because unemployment is high and the labor market is far from maximum employment. We think that's appropriate. We do monitor all those things carefully. It's true that some asset prices are elevated by some measures. It's true that overall asset prices, I would say, are somewhat elevated. At the same time, we have a very resilient banking system, and we spend a lot of time making the capital markets more resilient as well. So overall, we're in a situation where accommodative monetary policy is working through financial conditions to support economic activity, and that's an appropriate thing.
Thank you.
Thank you.
Thank you, Madam Chair.
Time has expired. The gentleman from Ohio, Mr. Stivers, is now recognized for 5 minutes.
Thank you, Madam Chair. I appreciate it. Chairman Powell, thank you very much for being here today. I want to thank you for your steady hand of leadership during these very turbulent times. I also want to thank you for being the most accessible Federal Reserve Chair in the last decade. During my time here, through 3 Federal Reserve Chairs, you've been absolutely the most accessible to us as policymakers, and I really appreciate that. I want to acknowledge your comments earlier about an appropriate direction forward for vaccinations to ensure we can open up the economy, and job training if we want to create jobs and get people to your maximum employment target. I'm not going to have you comment on whether the current COVID response bill focuses on that, because I know you don't want to be put in the middle of that. But I think it's fair to say anybody that researches it will see that the job training money rounds to zero, and there's not enough focus on vaccinations, in my opinion. I do want to move to something that I think you can and will be willing to talk about, and that's in the hospitality, travel, and entertainment industries. Do you believe banks and the capital markets are currently able to serve their capital needs with the regulatory flexibility you've given them?
Yes, I do believe that.
Okay, thank you. And I think that one of the problems, though, let me ask you, is when they're so shuttered and their capacity is reduced, are banks and the capital markets as willing to give them money?
Well, I think what we see is banks are leaning in to businesses. They're working with their customers and leaning into businesses that look like they have good prospects.
Yep.
You get to a place though with some of the companies that are really under a lot of pressure where they may be having a hard time. getting funded.
Right. And I think that speaks to the fact that as policymakers, we have been very reluctant to do targeted relief to specific industries. But given the uncertain recovery, and I'm not going to ask you to comment on this because I think it is a question for policymakers, I do believe that we should focus a little more on some targeted relief to some of those industries. That's why I'm a sponsor of the Restaurant Act and this new Gym Act and some other things in the hospitality, travel, and entertainment industries. And I think that would be smart of policymakers moving forward. I do want to allow you, because I don't think I've heard you say it, to comment on the Federal Reserve's independence. Just remind us whether you work for any president or you're independent.
We have certain legal independence, and we think that arrangement has served the public well. And that's really the point of it, is that we're able to make decisions without considering politics. And our lives don't change when elections happen until, of course, the president has the power of appointment.
To appoint every term. Yeah. Thank you. That's. I do want to quickly move to digital currency. You had a great interaction with Ranking Member McHenry about some of your concerns on the policy questions. I just want to quickly, and you brought it up, I just want to quickly speak to the potential disintermediation that could occur with the digital dollar. While I think it's important to keeping the dollar the reserve currency of the world, I think we need to take a special look at disintermediation. And I want to just remind you something I showed you a few hearings ago of one of the last banknotes from the Citizens National Bank of Ripley in 1929 that my grandfather got to sign. I think our financial institutions might be able to play a role in a digital dollar. And I just want you to think through those things. I don't want to ask you to comment on without thinking about it, but I hope you are committed to working with our financial institutions.
Yes, that'll be part of the conversation for sure.
And the final thing, I want to talk about something Mr. Cleaver talked about, and I want to take a step back and not just focus on CRA, but focus on the gap in home ownership, the racial gap in home ownership. And I'm curious if the Federal Reserve is paying attention to that as an issue, as opposed to, the four corners of a CRA document, but the issues related to reducing the racial gap in home ownership. And I know Mr. Cleaver and I on the Housing and Insurance Subcommittee are very focused on that and trying to work on some things to build a sustainable model. The last time we did this under Barney Frank, we created subprime lending that ultimately blew up the financial markets. I want to make sure that when we do it, we create a sustainable model that can bridge that gap and bring up the minority home ownership rates significantly. Is that something the Fed's willing to work with us on?
We'd be happy to look at that. I mean, our principal role there is to assure, to the extent using our tools, that gap is not a function of discrimination, and it will be to some extent. But we use our tools to go after lending discrimination and try to minimize that.
Thanks for your great leadership. I yield back my time.
Thank you. The gentlewoman from Ohio, Mrs. Beatty, is also the chair of the Subcommittee on Diversity and Inclusion and is now recognized for 5 minutes.
Thank you, Madam Chair. And thank you to Chairman Powell on being here today and providing us with your testimony on the salute of monetary policy. I want to start by revisiting a topic that I have raised with you several times over your tenure, and that is, of course, diversity at the federal level. Certainly, this is a topic that I think you can respond to, and it won't have an effect on the economy as maybe some of the other questions. You're probably familiar with that last month, the New York Times released an article entitled, "Why Are There So Few Black Economists at the Fed?" which found that of the 417 economists that are employed by the Board of Governors, only 2 Black, that's 2 out of 417, or 0.5%. While I understand that many will say that something is difficult to find or difficult to hire, just keep in mind 2 out of 417. I also understand that we need to do more to increase the numbers of Black PhD economists in general, because they only make up 3 to 4% of the population, and the Federal Reserve's representation are still lower than this number. Further, the reserve banks around the country only have about 1.3% economists that are Black. So my question to you, Chairman Powell, and let me just say for the record, I appreciate your contacting me, meeting with me, and always making great strides with OMWI and other things that you've done in this area. But are there any concrete steps that the Federal Reserve can take, or that you are taking, to increase the number of Black economists within its ranks? And do you believe that the Federal Reserve's role as the nation's central bank has a role to play in encouraging diversity and inclusion? And the word equity is very important to me in the economic field in general.
So I think we do have a role. We are a very large hirer. I think by some measures, the largest hirer of economists in the United States, including the 12 reserve banks and the Board of Governors. So it's, we're an important factor. And as you know, diversity is a high priority for me and for my colleagues and for our staff. And we do, what we've been doing is recruiting very aggressively and going to not just the old traditional schools, but also historically Black colleges and historic and Hispanic ones as well, and recruiting hard when we find appropriate candidates. We also have at different levels. We've got an internship program. We do the same thing there. Sort of more from an upstream perspective. We also want to increase the supply, because there's a fairly limited supply. We don't seem to be getting our share, and we don't know exactly why that is, but we're looking into it. So we're doing everything we can. Nobody here is comfortable with these numbers. Nobody. And we're wide open to suggestions on how to do better.
Thank you. I have one last question if I have time. Over the course of next year, tens and perhaps hundreds of millions of Americans will be receiving the vaccinations and will finally be hopefully placing this pandemic behind us. Looking out to an economic environment post-pandemic in 2022, let's say, what do you believe will be the potential lagging economic impacts of this pandemic? Who and what should the Congress be focusing on to address this from an economic standpoint?
Interesting. So what will is that the parts of the economy that are not open right now, or not fully open, will open up, and people will go back to work. But what we're going to find, based on some of the surveys we've heard about, is that not all those jobs are going to come back, because people have started to implement automation and things like that. These are service sector jobs, and that's been an ongoing process. It will have been accelerated. So many of those people may find it hard to get back to work, and I think they're going to need further support. So I would be looking at that over time, as the livelihood that they had in the service sector may not be easy to replace. There just may not be enough jobs. There's going to be a need for training and replacement and support in the meantime, so that these people can hang on to the lives that they had and find new work.
Thank you, and I yield back.
Thank you very much. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Chairman Powell, thank you for your dependable leadership, especially during the pandemic. And once again, we appreciate your accessibility to members of Congress, especially during this tumultuous time in our economy. As Congressman Luetkemeyer pointed out, in December, I led a letter to you with 46 of my House Republican colleagues outlining some of the methodological challenges with injecting climate change scenarios into supervisory stress tests. We urged you to take a measured, thoughtful, data-driven approach as you study climate impacts, while some on the other side have urged the Fed to stray outside its mandate and take a more active role in fighting climate change. In your response,
you stated, and this is it, your response, you stated that, quote, Congress has entrusted the job of directly addressing climate risks to a number of federal agencies, not including the Federal Reserve, end quote, and that you'll consider climate impacts only when doing so falls within your congressionally directed mandates. In January, the Fed announced the creation of the Supervision Climate Committee, led by Kevin Styro. In a press release about the Styro announcement, New York Fed President Williams said, quote, climate change has become one of the major challenges we face, which impacts all aspects of the Fed's mission. President Williams' statement seems contrary to the stated board position from your letter and your response to me. Can you please clarify his statement and how the new SCC fits within the board's limited mandate?
So I'm not familiar with the context or that statement. I'll just say, though, that we do see the job of the Supervision Climate Committee, and our job, frankly, is to assure that the institutions that we regulate and supervise are resilient to all the risks they face, and that includes climate risk. That's a conversation we're having. And by the way, all of the large and medium-sized financial institutions are already having that conversation too.
Well, let's drill down a little bit about how expansive the Fed will get into this, because as you know, the Fed recently joined as a member of the Network for the Greening of the Financial System. The NGFS has made some recommendations that, if implemented in the United States, could have harmful effects on U.S. banks and the businesses they serve. Our letter asks that you not import any NGFS standards that would harm the financial system or U.S. businesses, and in your response, you committed to this. How do you plan to evaluate NGFS proposals through the lens of upholding this commitment?
Well, as I said in the letter, as my colleague and I said in the letter, we're not going to import anything into the United States that we don't think is appropriate for the betterment and support and safety and soundness of the of the U.S. financial system. But we're actually at a much earlier stage than any of that conversation would suggest. We're really engaged in outreach and in thinking about frameworks. We're talking to these institutions. We're talking to supervisory institutions here in the United States and around the world. So we're at an earlier stage than.
Well,
that suggests.
And that's good to hear, but I do worry that injecting climate risk scenarios into stress tests could perpetuate the trend of debanking legally operating businesses like fossil fuels. In your letter, you commit that the Fed will not dictate what lawful industries regulated firms can serve. Even without a directive from the Fed, climate scenarios and stress tests may compel firms to debank certain industries to satisfy the spirit of the tests. My comment here is that limiting capital allocation to specific industries may itself have implications on financial stability and economic growth through lost jobs, higher energy prices, and compromised energy security. And final point here, I would like the Fed to keep in mind that choking off capital to fossil energy will not only produce the kind of reliability challenges we saw last week in Texas, it will undermine the Fed's maximum employment mandate. Final question on inflation. Yesterday, you said you weren't concerned about the threat of inflation, but some of the economic indicators are blinking warning lights for me. High asset prices, rapidly rising bond yields, elevated commodity prices, historically high year-over-year increase in the money supply as measured by M2. And these are on top of the unprecedented monetary and fiscal stimulus enacted last year and the $2 trillion fiscal blowout this week. Within the bounds of the Fed's new monetary policy framework for a long-term running average target for inflation, how high are you willing to let inflation get, and for how long before you step in?
We don't have a formula in mind. I would just say that, as I've said earlier, we do expect inflation to move up, both because of some sort of technical calculation reasons called base effects, but also because we'll have a surge in spending perhaps later this year. We don't expect that will be particularly large, or even more, that it will be persistent, because it's in the nature of a one-time thing, whereas inflation is a process that gets going over a period of years, and we don't think and we're committed to the idea that it will not become a persistent thing. It is ultimately the credibility of the Fed and our commitment to a price stability mandate that holds inflation where it is. We haven't changed that.
Well, thank you for monitoring that closely, and I believe my time has expired and I yield back.
Thank you. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes. Mr. Lawson is recognized for 5 minutes. Mr. Lawson.
Am I unmuted?
Yes, I can hear you.
Okay, thank you very much. Thank you, Madam Chair, for calling this meeting. The Federal Reserve warned of significant rise of businesses, bankruptcies, and steep drops in commercial real estate prices in a published on Friday. Commercial real estate, which I have a great deal of interest in, might be hit again after the pandemic. Some economists say an increase in people working from home could result in less demand for office space, while stepped-up online purchases could force more shutdown of brick-and-mortar retail in addition of vacancies at shopping centers. My question to you, sir, is what is the Federal Reserve plan for commercial real estate?
Well, we don't have a plan specifically for commercial real estate. I will say that we do see a number of sectors of commercial real estate that are under pressure, as you suggest, particularly office, hotels, things like that, which are directly affected by pandemic. You know, the best thing that can happen for the commercial real estate sector is for the economy to get back to full operating status, by which I mean get the pandemic behind us.
Okay, and there's been a lot of interest even last year in this particular situation, especially as it relates to hotels, the number of people that have been laid off in that industry, which is significantly higher in that particular area than maybe it is in bailing out the airline industry. Do you see any similarity in the retail industry as related to the airline industry that we bail out?
Do I see a similarity between the retail industry and those decisions are not decisions for us. That was a decision made by Congress and the administration as to you know, the provision of the particular funding for airlines. We're not part of that discussion.
Okay.
We're part of that
Well,
discussion.
okay, thank you. It has been suggested by some that all of our challenges with unemployment, homelessness, and poverty will be solved if we simply lift local restrictions and open up our economy. But since the beginning of this crisis, you have stressed that the path of the economy continue to depend significantly on the course of the virus. Will you please elaborate on why this is the case, and will the economy fully recover if people don't feel safe and comfortable that the virus is contained?
Yes, I will. A big part of the parts of the economy that are not operating at full capacity are the ones that are affected directly by COVID. The rest, big parts of the economy are largely recovered or even fully recovered, but that part of the economy is not. And that's travel and leisure, hotels, entertainment, all those things. And you know, what those sectors really need is an end to the pandemic, and people will then become confident again that it's okay to stay in hotels, okay to go on vacations, okay to go to bars and restaurants. And I frankly think that'll take some time. And I think that is the single key factor in getting that done. That process started and then completed will be bringing the pandemic to a decisive end as soon as possible.
You know, back in January, my time to run out, you stated that the winter months were going to be extremely hard on the recovery of the economy. Have you seen that your statement has been pretty much right in terms of where we stand at this point in the recovery in the economy?
Yes, so we did go through a very large spike in cases. As you know, they're coming down sharply now. The economy did kind of go sideways for the last, through January. I mentioned in my testimony, 29,000 jobs a month. It was much higher last summer. And, I think as the pandemic recedes, if it continues to recede, new cases are way down, hospitalizations are way down, then we'll begin to see, maybe fairly soon, we'll begin to see the job numbers start to creep back up. And hopefully this time that'll be consistent with keeping the virus under control, getting it really under control.
Okay, thank you. With that, I yield back.
Thank you very much. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. And also, Mr. Chairman, thank you for being before our committee today at this virtual setting. You mentioned that there could be 6% growth. We've talked about that all day today by the end of the year. And I completely agree and think
much faster than I
the fundamentals are there for the economy to easily rebound at this pace. The biggest obstacle I see that would prevent the level of growth from becoming a reality is individual states forcing businesses forcing them to remain closed. Now, for states like mine, Texas, the great state of Texas, that have responsibly opened their economies, people are getting back to work. And in December, Texas added 64,000 jobs, while states that are still under heavy lockdowns like California had over 2,000 jobs lost over that same period. So as we talk about the next step in COVID relief, it needs to be focused on getting people back to work. So, Mr. Chairman, what would be the best allocation of resources that would incentivize reopening the economy?
Well, I would say again, I'm as you know, I'm reluctant to comment. I'm frankly not. I shouldn't comment on the legislation that's under consideration, and I won't do that. But I'll say again that I think it's at this point the single biggest thing is to get people vaccinated and get the pandemic under control in a decisive kind of a way, and then the economy can fully reopen and people can get confident again that it's okay to resume their normal activities.
Okay, I'll buy that. My district contains some very rural areas that do not have access to reliable broadband internet. And the COVID-19 pandemic has exposed how necessary it is to be connected to the internet if you want to run a business, take advantage of telehealth capabilities, or educate your children. We've got some strange stories that people have to find hotspots in my district and drive hours to get there. Chairman, can you tell us what it would mean for the economy, or economic recovery, if we were able to get investment in broadband infrastructure for the thousands of American people that are currently being left behind in this digital world?
Again, without commenting on the bill, I would say that broadband is just an essential piece of 21st century infrastructure, and having good broadband everywhere in the country will help people in rural areas and poorer people who may not have access and things like that. It's a very important piece of infrastructure for us to have as a nation.
Well, it is, and surprisingly, like I said, in my district, a lot of rural America still does not have it. We need to get that, and I think we agree on that. Lastly, during the Trump administration, you were applauded for maintaining the independence of the Federal Reserve and focusing on your dual mandate of price stability and full employment. You're going to be pushed once again during the Biden administration to use the power of the Federal Reserve to pursue additional political goals, such as addressing income inequality or climate changes. And I just want to reiterate that some of my colleagues have already brought that up, and Congress is the body that must debate and act on these ancillary issues, not the Federal Reserve. So in closing, Mr. Chairman, can you tell us listening today why it's important for the Federal Reserve to stay independent and not act on the political needs of the moment?
I will. I'll be happy to. The independence of the Fed from direct political control is an institutional arrangement that we think has served the country well, and that's why we have it. It's not something that's in the Constitution. It's a practice that we have. We don't engage in political discussions over here. We don't take politics into consideration or election cycles or anything like that. Nonetheless, we try to be extremely transparent and really work hard to stay in contact with the body that has oversight responsibility in our system of government, which is the two committees on Capitol Hill. That's where our oversight responsibility is, and we take that very seriously.
Well, I will turn my time back. I want to thank you for the job you're doing and appreciate your the hard work that you've generated these last several years. So thank you very much. And Madam Chairman, I yield my time back.
Thank you. The gentlewoman from Iowa, Ms. Axney, is now recognized for 5 minutes.
Thank you, Chairwoman, and thank you, Chairman Powell, for being here. It's good to see you. I want to focus on the labor market a little bit here. You said a couple of weeks ago that published unemployment rates have dramatically understated the deterioration in the labor market. And as I understand it, that difference is mostly about the decline in labor force participation. Is that correct?
Yes, that is correct.
So that's something that I clearly see in Iowa. Our unemployment in December actually fell back below 3.5%, but that ignores about 130,000 Iowans who've just left the labor force completely. Is that something that you will be looking at closely when it comes to determining if the economy is at full employment, those folks who have literally just left the market?
Yes, it is. We say that we look at a broad range of things, and it's important to say that we look at the employment rate and employment to population, in particular, as a statistic that combines labor force participation and unemployment.
Okay, good. I'm happy to hear that. So changing course here a little bit, we've seen about 4 million people leave the labor force. Almost 60% of those have been women, despite them making up, of course, less of the labor force before the pandemic hit. And then we hit a 33-year low last month, and more than 1 million more women have lost their jobs than men. I would ask you, Chairman Powell, what do you think is the reason for this kind of disparity? And is that something you're going to consider when you're evaluating full employment?
It's a combination of two things, I believe. One of which is that women are within the labor force overrepresented in those public-facing service sector jobs. The other just is with the closure of many schools, parents are staying home, and that burden has fallen more on mothers than it has on fathers. Those are the two pieces of that, I think. And both of those should dissipate, and we'd go back to hopefully something closer to where we were, where people worked if they wanted to work, and they did childcare if they wanted to do that instead. So as the pandemic comes to an end, we hope that people once again be able to make those choices without taking into account the fact that the schools are closed, for example. So.
Thank you. Listen, I'm so glad to hear you bring up childcare because apparently more than $50 billion a year is what the lack of childcare costs our country. Do you think that helping families find affordable childcare could help the economy? And do you think that would help us get back to full employment more quickly?
I do think that's an area that's worth looking at. And again, I don't want to comment on I don't know what's in your discussions, but I don't want to comment on that. I will say many other countries, our peers, our competitors, advanced economy democracies have a more built up function for childcare, and they wind up having substantially higher labor force participation among women. We used to lead the world in female labor force participation a quarter century ago. And we no longer do. And it may just be that those policies have put us behind.
I appreciate you saying that. Countries like Germany, UK, and Canada have moved forward with higher levels of that participation because of those programs. And it's absolutely something we need to address in this country. Obviously, even before the pandemic, it was prohibitively expensive for families. I've been there. I have 2 boys, and at the most expensive time, even 15 years ago, it was you had to save $20,000 after taxes, and that was 15 years ago for a couple kids. So I know that this is really hurting Americans, and there are childcare deserts. The lack of childcare and paid leave as well really limits the choices for women in America. And every time one of them leaves the workforce to take care of a child, it sets their career back multiple years. So I just want to be clear, this isn't just a women's issue, it's a family issue, it's an economic issue. And I worry that the current crisis for childcare could get even worse. It's why it's so important to address these types of long-term issues if we're going to be back to where we need to be as a country. I would also encourage you to look at how paid family leave, paid sick leave, all of those issues impact opportunity for women and for families, which in turn, of course, impacts our overall economy. I want to thank you for the work that you're doing. Appreciate everything that you're doing to try, make sure that we're informed and keeping our country moving forward. And I'd encourage you to take a look at those issues. And lastly, I'd say on the paid family leave, is that something else that you would be considering looking at when it comes to labor market?
You know, those are decisions that lie in your hands, but I do think it's worth looking at these. As the United States falls behind in labor force participation, we need to be asking why that is the case and what are the ways we can be more competitive.
Thank you.
Thank you. The gentlelady's time has expired. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell, it's great to see you. Thanks for your time on Capitol Hill this week. And we do appreciate, as everyone has said, your extraordinary leadership and the Board of Governors during this tough past year. Since last March, the Fed has purchased more than $1.8 trillion of U.S. Treasury securities. And last week, you reiterated, as you did yesterday in the Senate, that the Fed remains patiently accommodative in its monetary policy position. But this extraordinary amount of accommodation is now coupled with the decision that the Treasury has recently announced, Chair Yellen, that they are planning on drawing down their cash account they hold at the Fed by almost $1 trillion, which would inject that directly into the economy. My question, Chairman Powell, is, has Secretary Yellen discussed with you drawing down the Treasury account?
As a matter of long practice, I don't discuss my private conversations with elected representatives or with the Treasury Secretary. But of course, we're well aware, you know, there's an ongoing staff level dialogue, you know, about between Treasury and the Fed and the New York Fed about the Treasury General account and what the plans are for that. So we're well aware of it.
If $1 trillion was drawn out of that account and injected, do you think that could cause short-term interest rates, something you're very concerned about at the Board of Governors and a very keen focus on monetary policy? Could that cause short-term rates to go negative?
So it could put downward pressure on short-term rates. Of course, our principal concern is that the federal funds rate be within the range that the FOMC has ordered it to be. And we have the tools to make sure that that's the case. And if that is the case, and it will be the case, that we'll be within our range, we'll be where we need to be. That's going to tend to work against the other, you know, short-term money market rates going too low.
Yeah. No, it's a key point. That's why I'm concerned about that impact in the market understanding it. I mean, for example, I assume the Board of Governors, from a monetary policy reaction to that, if short-term rates went negative, is you could raise the rates on the IOER range that you have. Would that be a tool that you could take into effect?
Yes, we haven't made any decisions about this at all, but of course that and also the rate on the reverse repo facility are the two things that we can move. And those are our two administered rates. And so those would be the tools that we can use, among others, frankly, but those are things that we can do.
Well, certainly in light of what Ann Wagner asked about a few minutes ago on the supplemental leverage ratio, these things kind of come together in the banking system, and managing those expectations, either the level of short-term rates or the dislocation in rates and the Fed's reaction to it, or that kind of cash coming out into the banking system and thus aggravating that supplemental leverage ratio. These are important issues, and I would encourage the board to consider action sooner rather than later because of that March 31 date. Chairman Himes raised a really interesting question, and Mr. Barr did as well, about the indicators you look at when you're evaluating this inflation move. We've mentioned raw commodity index. I think other members have mentioned that it's up 18% year over year. Gold is up 15% year over year. But the one I always watch, and we saw it come into play in the run up to the last financial crisis, is residential real estate. As you know, 24% of the CPI is an imputed rent that the Bureau of Labor Statistics uses. I've never bought it. I don't know if you've ever bought it, but it's up about 3% right now. But if you look at the prices of existing homes, I think they're up 12. new home prices are up 8%. Is that one that you particularly focus on, that imputed residential rent, since it is about 25% of the CPI, and how do you look at that issue?
We do, of course, follow a broad range of prices. It's half of our mandate is price stability. So we have a lot of attention paid to many different things. The most important thing really is inflation expectations. Are they anchored? And we have great tools for looking at that, including a new common index of inflation expectations. You ask about real estate, housing, residential real estate prices, and the very high levels of increases, we saw this year. There were a bunch of one-time factors. There was a suppression of demand at the beginning, and increase in demand as that industry reopened. Rates are low. People are working at home. All those things tend to rates will be low for some time, but people working at home won't be forever, and all those things tended to push up demand. Our best estimate is that we will see price increases, but they'll be much lower level.
Thank you.
Mr. Chairman. I yield back. Thank you, Mr. Chairman.
The gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Powell, it is so nice to see you again, and I mean this genuinely. You have a hard job, and you've always biased in favor of clarity rather than opacity as you balance some of the political tensions of your job. And we appreciate that, and the country appreciates that. It makes our jobs easier. I mentioned that at the start because I want to sail into issues that are political but shouldn't be, and it's been the subject of a lot of my colleagues' questions around climate change. The transition to a greener economy, as lots of smart people have said, imposes physical risks and transitional risks. The physical risks, I don't think, present much of a political challenge. What's happened in Texas, I think there is, nobody suggests that we shouldn't be dealing with those types of physical risks to our economy. The transitional risks are hard, though, because converting to a clean energy system means converting to an energy system that has lower marginal operating costs, which leads to a rising tide. It's good for the economy, but the fact that a rising tide lifts the average boat doesn't mean it lifts every boat. And at core, that transfer is the transitional risk is a wealth transfer from energy producers to energy consumers. You pay less for energy, but now somebody's got to write off their fossil fuel reserves. That, in my view, informs much of the political risk or the political conversation that exists. So I'll get to in a minute why I start that way, but first I just want to follow up on what Chair Velasquez asked. On Monday, Janet Yellen said that climate change is a part of the broader mandate of the Treasury Department. Do you agree that the economic risks of climate change are part of your broader mandate as well?
I think that we have a mandate to assure the safety and soundness of financial institutions, and that involves making sure that they manage and understand all of the risks that they face, and that includes climate change risk.
Okay, well, I certainly do. I think some of the estimates are north of $20 trillion a year of loss. Last week, Governor Brainerd noted that there have been over $5.2 trillion in the losses associated with the physical risks of climate change. Since 1980, 70% of that, which is not insured, and of course that is accelerating. What is the Fed doing specifically about the exposure that the financial sector has to those physical losses from climate change?
So as I mentioned, we're really in the early stages of understanding this. Right now, we're doing a lot of outreach. We're talking to different size financial institutions and other external constituencies, our fellow regulators here in the United States and around the world, to try to, we don't have a framework for thinking about this. There are tremendous data gaps. It's not, it's just early days. And by the way, if you talk to certainly the large and medium-sized financial institutions, you'll find they are very actively doing the same thing. They're trying to think about what are the implications, longer run implications, near-term implications of this. How do I think about it? And so I would just stress that it's early days. And I also want to stress that, the nation's climate policy has to be decided by elected people. We are not climate policymakers here who can decide, the way climate change will be addressed by the United States. We're a regulatory agency that regulates a part of the economy, and part of that job will be to assure, as I said, but it's not we're not the central issue here.
I don't mean to be rude, but I got two more questions I want to hit. I completely agree, and that's why I led off by noting that there is this political challenge because of the wealth transfer. Because we need, we are political creatures on our side of the dais here, and you noted to Mr. Lutkemeyer that stress tests and scenario analysis are very different, and I totally agree. The beauty of scenario analysis is that it's flexible; it can accommodate more information, particularly as we get into some of these transitional risks. The downside is that they're flexible, and therefore they are going to be subject to political pressure. So we can't do those very well from our end. But as you think about how to build the modeling infrastructure in the Fed, how are you thinking about how to build that in a way that is accurate, that captures the risks, but allows you to maintain the political independence you need?
So, that's a good way to capture it. It's quite a challenging exercise. It's scenarios. And by the way, some of the banks are already running these scenarios. They're already thinking about it. They're supposed to be informative. They're supposed to be illustrative kind of thing. That's what they're not at all like stress tests. And it's just worth this level of thinking. How do we model this? And what are the implications of how we model it for our business today? One thing we're doing is the Bank of England is ahead on this. They're working on this. So we're very closely monitoring and in ongoing discussions with them. I just think there's a lot of work to do here before we can really, make progress.
Well, thank you. I yelled back a minute ago.
Thank you. The gentleman from New York, Mr. Zeldin, is now recognized for 5 minutes.
Thank you to the chairwoman for holding today's hearing and the ranking member, Chairman Powell. You're one of the unsung heroes of responding to the pandemic. I want to thank you and your team for your efforts throughout 2020. That's also included standing up and fine-tuning the liquidity facilities. For example, the original municipal liquidity facility had excluded Suffolk County, which is my home county, but the Federal Reserve and Treasury listened to the concerns that I and others raised and lowered the population thresholds for the eligible issuers. This provided an important possible backstop for local governments concerned about liquidity when they issue debt. I appreciate the Federal Reserve's attention to this critical market and the commitment to remain vigilant of any problems as they arise, because we do need all levels of government working together. Another issue with which I'm concerned with is the rising national debt, which now stands at over $27 trillion. The scariest part of this issue is the fastest growing part of our federal budget is paying interest on our national debt. And that's right now operating at a time when interest rates are historically low. You testified before the Joint Economic Committee on November 13th, 2019, and you said, quote, "In a downturn, it would also be important for fiscal policy to support the economy. However, as noted in the Congressional Budget Office's recent long-term budget outlook, the federal budget is on an unsustainable path with high and rising debt. Over time, this outlook could restrain fiscal policymakers' willingness or ability to support economic activity during a downturn. In addition, I remain concerned about that high and rising federal debt can, in the long term, restrain private investment and thereby reduce productivity and overall economic growth. Putting the federal budget on a sustainable path would aid the long-term vigor of the U.S. economy and help ensure that policymakers have the space to use fiscal policy to assist in stabilizing the economy if it weakens." End quote. Those were the end of your remarks. I just wanted to cite. The national debt stood at roughly $23 trillion at that time. Since then, we've gone through a downturn due to widespread lockdowns as a result of the pandemic, and Congress has passed 5 bipartisan COVID-19 response bills. We are still struggling with a fragile economy, and many restaurants, small service industry businesses, and others still need assistance to succeed in rebounding from the pandemic. I've been supportive of targeted help. This can't be an across-the-board handout because someone's going to have to pay the bill. We definitely shouldn't be appropriating more funding in areas where they haven't even used the funding that's already been appropriated. Chairman Powell, I wanted to ask you to talk a little bit more about what you said in November of 2019 and why it still matters at this time for the future.
I'd be glad to. So we're on a unsustainable fiscal path, which just means that even in good times, the debt is growing faster than the economy. That's kind of the one definition of unsustainability. And we need to get off that path. We will get off that path. I would say the time to prioritize those concerns is not now. It's when the time to prioritize those concerns is when we're close to full employment, when the taxes are rolling in, and we can do it without so much pain. Right now, fiscal policy is, I think, appropriately working, as I suggested in those remarks. Fiscal policy really came to the rescue in this episode with the CARES Act and the subsequent things that have been done. So I do think it's important to save that firepower for big times when it's really needed. And this is one of those times.
At this time, the Congress is about to pass a $1.9 trillion COVID-19 related bill, but a lot of that spending won't be until 2022 or later. Some of that spending isn't even to be spent until 2014 or later. And I just want to know what your thoughts are on so much of that funding in this week's bill not even being used anytime this year.
So I think it's not appropriate for me to insert myself into these discussions, which are really the province of you and your elected colleagues. We have a narrow and important mandate, and we're generally not consulted or part of these discussions, and that's appropriate.
Chairman Powell, I appreciate your leadership. You really did a fantastic job responding to the pandemic, and I yield back.
Thank you. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Madam Chairwoman, and thank you, Chairman Powell. When we last spoke in front of this committee 1 year ago, you thanked me for sharing the history of these Humphrey Hawkins hearings and the legacy of Coretta Scott King and her advocacy for a federal jobs guarantee. Today, we're in the midst of the greatest economic disaster since the Great Depression. And during the height of that crisis, the federal government created 4 million jobs in the winter of 1933. Chairman, you've noted that the goal of maximum employment will require more than supportive monetary policy. Would a federal jobs program succeed where monetary policy and the private sector have been unable to meet the need?
So I was speaking really about the longer term and the need to have policies that support peoples, that give them the skills and training that they need to take part, and also policies that support participation in the labor market. I think it's up to you to pick the particular policies, but I do think it can't just be a matter of monetary policy, because we can help over the course of an expansion, but there are longer term issues that will support maximum employment over time that are really in your hands.
Agreed. And the federal government can create jobs that meet the scale and speed necessary, I think, to meet this moment. Last week, I introduced House Res 145, a federal jobs guarantee, calling for just that. A central demand of the civil rights movement, a job guarantee is about more than just jobs and the dignity of work. It's about the necessary public services and critical but long neglected physical and care infrastructure we can provide. A federal job guarantee is our opportunity to achieve a just recovery as well as long-term economic equity. In this pandemic, as you're aware, Mr. Chair, women have lost 5.3 million jobs, 1 million more than men. Women of color have sustained the highest unemployment rates. In fact, in December alone, 154,000 women, Black women, left the workforce, the result of lost jobs and the caregiving crisis. This reality is devastating, but you recently noted that even the sobering unemployment data that we have has incredible gaps in measurements. Specifically, that if we consider the near 4 million people who have stopped looking for jobs, the actual unemployment rate would not be 6.3%, as reported by the Bureau of Labor Statistics, but close to 10%. So how does Chairman Powell the undercounting of unemployment, prevent us from achieving an equitable economic recovery? And what does this mean for women of color specifically?
Well, I think that the numbers, this is, by the way, it's not a criticism of the Bureau of Labor Statistics. They're very transparent about what they do. But conceptually, I think that you include those people who were in the labor force working and now they're out of the labor force, but they're actually unemployed, for my way of thinking. You know, women and women of color in particular are overrepresented in those public-facing service sector jobs, which have been so hard hit in hotels and restaurants. And so this downturn has just been terrible from the standpoint of affecting a group that already was financially less able to withstand those kinds of things. It's from that standpoint, particularly since we had begun to make significant progress, some progress on those issues, those longstanding disparities. So, you know, we're in a situation where the best thing we can do is get those sectors open as soon as possible. And in the meantime, give people the support they need so they can continue the lives that they've had.
Sure. That undercounting, though, I do believe it's just another way that our economy renders invisible and further marginalizes those workers consistently, who are the last ones hired and the first ones fired. Particularly true for our disabled workers, LGBT, Black women, those who have been disproportionately, to your point, employed in the service sector, low-wage jobs that have been deemed essential, but are often treated as if they are dispensable. And that's not true only in a pandemic, but especially so. So Chairman Powell, looking to pass recoveries for the workers shouldering the heaviest burdens of this pandemic, will they recover their jobs as quickly as they lost them? What are your projections there?
We don't have great confidence in our ability to project that, but I would say as the economy reopens, there should be a wave really of people going back to work in those sectors. The question is going to be, some of them will not be able to go back to work because, you know, we're hearing their surveys suggesting that those companies have been figuring out ways to do their business with fewer workers. And they're doing that all the time, but that process may have been accelerated because of this episode. So it's pretty likely that some of those people will not be able to go back to their old jobs, and they're going to need continued support and help to find their way in this post-pandemic economy, which will be a different economy.
The gentlelady's time has expired. The gentleman from Georgia, Mr. Laudermilk, is now recognized for 5 minutes.
Well, thank you, Madam Chair, and Chairman Powell, thank you for being here. And let me tell you, the 4 years that I've been on the committee, it's been a roller coaster ride, especially with the pandemic, and I appreciate how you have worked with us during that time. I also want to thank you for the interim final rule that the Fed issued with the OCC and FDIC back in November that provided temporary relief for community banks from asset thresholds. As you know, pandemic relief programs, especially or particularly PPP, have resulted in rapid growth of our financial institutions' balance sheets. And as a result, several hundred community banks were on the verge of being subject to additional regulations because of having PPP on their books. So I appreciate you and the other agencies addressing that. And I think that's an illustration of how we can put partisanship aside and do what's best for the American people and for our banks. So a question I have is, I'd also like to discuss the Community Reinvestment Act, as others have done today as well. I appreciate your comment earlier today that you're working with the OCC and the FDIC to get on the same page. As you know, the pandemic has accelerated the use of digital platforms like mobile and online banking. What I'd like to know is, will you and the Fed take that into account during the CRA reforms?
Yes, that is, excuse me, that is very much part of we understand that banking has changed, and that's one of the important ways in which it's changed, and that requires a rethink. It's been a quarter century since we had one, and that's a big part of why we're at the table.
Well, I appreciate that. Last week we had a markup on this huge bill that's coming to the floor, and I would appreciate if our colleagues on the other side would have the same outlook of addressing the changes in technology as we attempted to have fintech included in the package, but weren't able to do so. So hopefully going forward, that will also become a bipartisan issue that we can work together. So another question, Chairman Powell, could you remind us for what you see for the economic outlook for 2021. I believe you said that the economy should bounce back strongly and may grow at a rate of 6% this year. Is that true?
Well, so someone asked a question yesterday. They said, could it be 6%? And I said, yeah, it could be 6%. You know, that there's a range of estimates. I last made it, we're constantly updating things, but we'll be doing another round of estimates for growth this year at our March meeting. We do quarterly updates. Of course, we're updating them in real time in the meantime. But the bigger point is it all depends on getting the pandemic under control and getting people vaccinated, and it depends to some extent on these other strains that may be around. Haven't really had much of an effect yet, apparently, on infection rates, and we hope that continues. So, but there's, as I mentioned in my testimony, there's a reason for optimism about the second half of the year if we do get the pandemic under control, and that's what many people are forecasting now. And of course, we're going to wait and see the actual data before we act on it. We're not acting on forecasts when it comes to our policies at this point.
So whether it's 4.5%, 5%, 6%, you still believe that we should bounce back strongly?
Yes, I do. I think that's the base case. I think there's plenty of risk, but I would say that's certainly the base case.
Well, that's good to hear. I think we laid the foundation over the past 4 years of a strong economy, as long as we don't undo a lot of that. But I want to take a step back and think about really the economy in general and our ability to recover, and the fact that you think that we're going to have a strong recovery. As I mentioned earlier, later this week, the majority party in the House will attempt to pass a $2 trillion bill that economists are saying is 6.5 times bigger than what is actually needed. In fact, less than 9% of it would go to actually combating the virus through public health spending, as you have indicated already, is really what the key to this economy is, getting the virus itself, the healthcare aspect, under control and constraint. But only 9% of this bill is dealing with that. So I'm not going to ask you to comment on fiscal policy because I know that's not your job. But Congress should take the Fed's economic projections into account and recognize the economy is on strong track to recover and recover strongly. The bill is many times bigger than it should be, and it would spend trillions on items that have nothing to do with COVID and continue to accelerate the debt that this nation has that is running quickly out of control. And with that, Madam Chair, I yield back.
Thank you. The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for hosting Chairman Powell for this very important report. And Chairman Powell, it's a pleasure to see you again, and thank you for all the work that you've done to get us through this pandemic. I mentioned to someone, you just about threw everything but the kitchen sink at the issue. And quite frankly, that's what was required to make sure that all parts of the economy will get back on track. As a former local city official, in fact, I was city controller in Houston, I'm always concerned about the municipal bond markets and what is happening for cities in terms of meeting their obligations on any debt, being able to continue to issue debt, and in getting past this pandemic. And I know that all of us have called for the extension of the municipal liquidity fund, but because it was shut down at the end of 2020, states and cities can no longer rely on the MLF as a backstop. According to recent analysis from the Philadelphia Fed, state and local government employment is lower by 1.3 million since the pandemic, nearly double the losses from the 2008 recession. And states are using reserves, federal aid, and the capital markets to contend with budget deficits prior to the extreme austerity. I know I spoke to my mayor during our district work week this last couple of weeks, and the city of Houston was already at about 140 million shortfall, and that's not even looking at the decrease in plummeting collections on property taxes, because the city of Houston is about 40% reliant on property taxes. What can we do given the absence of the MLF and the precarious fiscal conditions that states and cities face? What sort of steps must be taken to avoid further public sector job losses or disruption in the municipal bond market?
Well, so the municipal bond market, I'm happy to say, has continued to function very well, even after the facility closed. And I'm happy to say that I was concerned that it was serving a purpose as a useful backstop, and it ended at the end of December, and nonetheless, the market's working just fine. In terms of other support, it's not for us to say. I would say that the disparities between different cities and states are enormous in this situation. Some cities and states are actually better off. The ones that are leveraged to either energy or tourism are not better off, because those are the areas that have been hit by the pandemic. And so, but that's really a question for fiscal authorities in terms of what further help would be appropriate. In terms of access to financing, it's really there. The municipal bond market is open, and right across the credit spectrum and the maturity spectrum, there's been the ability to finance.
All right, thank you. Also, during one of our previous visits, I had asked you about, I was curious as to why the poverty rates were not looked at more closely, in just like we look at unemployment. Because as you've noted already, the unemployment number is not perhaps the best true number of the people that are out of jobs. And certainly there's a lot of poor people that are not included in those numbers because they not only not have jobs, they're also not a part of the labor market, they're also not on unemployment. And I did note on your February report on page 19 that you noted that food pantries saw a significant increase in demand in 2020, and there was a sharp increase in the number of families reporting that they did not have sufficient money to buy food. What else do you all do to track that in terms of poverty rates, the number of people that are reliant on the SNAP program, the number of people that are reliant on other public benefits to give us a better picture of how many people may not be working?
So we do look at all of that data. We don't collect that data. Other parts of the government do, and I think we've all been struck. How could you not be struck by the uptake at the food in the food area, where people are in line, these miles long car lines to get food. It's some families are clearly in a place where they need help from the government just to feed their families. So it's a sign that that support is needed, and that we really need to get the economy recovered as soon as possible.
Well, thank you. I believe my time is up. I yield back.
Thank you.
Thank you for your good work, sir.
The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Chairman Powell, thank you for your time, and really want to commend the Federal Reserve for the work that was done at the end of March to provide liquidity and stability to our economy, to deal with the massive surge in demand for U.S. dollars. And we're just so grateful that the U.S. dollar has become the world's reserve currency in a time of crisis. Not just Americans, but people all around the world want our dollar. It is indeed a source of our strength as a country, is to have a strong dollar that has become the world's reserve currency. It does great things for our capital markets, and frankly helps enable the deficit spending that we've continued to do. Because we certainly haven't saved for bad times. We're able to navigate them because we still can borrow. I wonder, sir, do you have a definition of sound money?
We target inflation that averages 2% over time. That is what we consider to be.
Well, that's a policy, but I mean, when you think of sound money, what would you say constitutes sound money?
Well, the public has confidence in the currency, which they do, which the world does. That's really what it comes down to, that people believe that the United States currency is perfectly reliable and stable in value.
Okay, so as a store of value, it clearly isn't stable in value. It is not. But as a store of value, the U.S. dollar really, is it diluted as a store of value when M2 goes up by more than 25% in 1 year? Does the printing of more U.S. dollars somehow diminish the value of the dollars that others hold?
You know, there was a time when monetary aggregates were important determinants of inflation, and that has not been the case for a long time. So you'll see if you look back, the correlation between movements in different aggregates, you mentioned M2, and inflation is just very, very low. And you see that now where inflation is at 1.4% for this year, both.
Yeah, you keep using that, and you keep using it to talk about inflation. And I don't think that's the only proxy for, whether the dollar is a store of value and an efficient means of exchange. It is clearly still the world's reserve currency, but we're putting it under a pretty big stress test by diluting the value of the dollars. And I think one of the indicators of that is when the U.S. government issues debt, all this spending that we've done as a country, it isn't really funded, is it? I mean, there's not a true market demand for this much debt. It's not being lent. When there's borrowing, there's actually a lender. How much has the Federal Reserve had to purchase to bridge the gap between market demand for treasuries and the actual need to finance the spending?
That's not at all what's happening. We don't have to purchase any of this. We purchase it because it is providing accommodative financial conditions and supporting the economy in keeping with our mandate. There's plenty of demand for U.S. Treasury paper around the world.
So all of it would sell. You're competing. So are you bidding up the price then? Is it your contention that you're inflating asset prices by increasing this purchase?
No, I think that we could sell all of our debt. That's the reason we do it. But by the way, we issue debt when we issue United States obligations in the form of reserves when we buy treasuries. So we're not actually changing the amount of obligations outstanding on the part of the treasury. What we're doing is we're substituting an overnight reserve for a treasury bill. It has no effect on the overall outstanding obligations of the United States when we do that.
Right. So the growth of the Federal Reserve's balance sheet, you don't think that has anything to do with the disconnect between Wall Street and Main Street? Or let's just take as an example the confidence people have expressed in Bitcoin and other cryptocurrencies, and well-respected, proven investors like Ray Dalio, who said cash is trash. Isn't it because the U.S. dollar is being destroyed by fiscal and monetary policy?
It's hard to say that it's being destroyed. I mean, if you look at, so another way to look at the dollar, if you mentioned the dollar, you can ask domestically what can it purchase, and that's a question of inflation. You can also look at it in terms of a basket of other currencies. And
yes, I understand, but if you look at it, sir,
the dollar is in
my time. The key to this is the Fed has done a horrible job at predicting asset bubbles. They have. And if the pensions are going up because the market prices are going up, people with marketable securities have their basket of wealth going up and wages aren't. Current consumption, teachers, for example, they have a great pension, but their current consumption isn't going up. So CPI lags what's going on in the investment. I think it's a big concern. And I would just implore you and the other members of the Fed to pay attention to monetary inflation, not just consumer price inflation. I yield.
The gentlewoman from Georgia, Ms. Williams, is now recognized for 5 minutes.
Thank you, Madam Chair. And thank you, Chairman Powell, for joining us today. Chairman Powell, the American people are looking to us to deliver a strong economic recovery. And as we work to vaccinate more Americans and end this pandemic, we're going to need smart fiscal and monetary policy to combat our country's economic downturn. So, Chairman Powell, you previously credited the past stimulus payments and unemployment benefits for helping jumpstart the economy. Given the current state of the economy, do you still believe these are tools that can both boost aggregate economic activity as well as help those disproportionately impacted by the pandemic?
In principle, yes. I think that's what those tools do. I'm not commenting on the bill, though, that you're working on right now. I don't want to be heard to be supporting or not supporting the fiscal package that you're voting on this week.
Understood. Do you believe that decisions made about fiscal and monetary policy can help determine the speed of a full economic recovery?
Very much so.
So could failure to use these tools delay our return to full employment, even if we get folks vaccinated quickly?
Again, I'm not going to comment on fiscal policy. We're committed to using our tools until the economy is fully recovered.
Chairman Powell, in your expert opinion, in what ways could monetary and fiscal policy be employed at this time to ensure our economic recovery is inclusive of communities of color and addresses racial economic disparities?
So we don't have, our tools lift the entire economy and aren't targeted toward particular groups. But I will say that what we saw in the last couple of years of the long expansion was that at very low levels of unemployment, very high levels of employment, high levels of participation, we saw benefits going to those at the lower end of the spectrum, which means disproportionately African Americans, other minorities, and women. And we saw that happening pretty consistently over the last 2 years. So with our tools, what we can do is try to get us back to that place where we have a strong labor market, high levels of employment, high levels of participation, wages are moving up, and those benefits can be shared really broadly. That is really the main thing. It's not the only thing, it's the main thing that we can do.
Thank you so much, Chairman Powell. And Madam Chair, I yield back the balance of my time.
It's now recognized for 5 minutes.
Madam Chair, the sound cut out. Would you verify that that's me, the gentleman from North Carolina?
Yes, the gentleman from North Carolina, Mr. Budd, you're now recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell, again, thanks for being here today. Massive $1.9 trillion COVID relief bill. So based on past relief bills, would it be safe to assume, or it would be safe to assume that we're going to see an increase in deposits stemming from that $1.9 trillion, but of the SLR or the temporary supplemental ratio, leverage ratio, would that be beneficial for banks to handle these deposits?
So the temporary exemptions from the SLR that we put in place last year expire at the end of March, and we're in the process of looking at that right now. I've got nothing to announce on that today, and it's a conversation my colleagues and I are having. I'm reluctant to get into the merits of the arguments at this point because it's something that I don't want to, presume or get ahead of that conversation.
Understand, and understand you may not want to commit to this part, but have you considered finalizing the 2018 interagency proposal?
We're looking at what to do on the supplemental leverage ratio, and I really would rather just leave it at that for now, if I can.
Understood. Chairman Powell, yesterday you mentioned that the digital dollar, it's a high priority project for the Fed. Appreciate that, but you also went on to mention that the Fed is more focused on getting it done right rather than getting it done fast. So getting it done right, especially for a project like this, we can all appreciate that. Now I know, the U.S. dollar is the reserve currency of the world, and I think we hope that doesn't change anytime soon. But with that being said, a lot of other countries are just leaps and bounds ahead of us when it comes to digital currency. A couple of them, I think of the digital yuan, Sweden's e-krona, also in Ukraine, and even in Uruguay in the e-peso. Is there any worry that the U.S. is falling way behind the rest of the world in the development of a CBDC? And does this staggered start, do you think that puts the U.S. at a disadvantage?
No, I don't. We are the reserve currency of the world, and that is because of our great democratic institutions, our vibrant economy, and just that we are the incumbent, and we have relatively low inflation. The value of the dollar has been relatively stable for some years now. And so I think we will be that. I think it's a very, very important decision that we make. And there are potential pitfalls. There are issues around privacy and how you structure it. And, it would be to do it as quickly as possible and get it wrong would be a very bad idea. So we're going to be careful. I do think that we have the time to think this through carefully. I'm not concerned that other countries are experimenting with this, but I have to say, it's possible now. Technology has made it possible, and it's happening, and the private sector is doing it too. So we understand that we need to be in a position of really understanding it and doing it if it's the right thing for Americans.
Thank you. we're quickly approaching the 1-year mark of the first implementations of the widespread lockdowns. And since then, we've been battling the continued public health crisis and the economic fallout that's come from that. So how much longer can our economy sustain the current level of unemployment? And also on top of that, the lack of economic growth before we really begin to suffer even more negative economic impacts?
That has been a major concern since the very beginning, is people out of the labor market for too long. They lose their skills, they lose touch with the industry they worked in. It's called scarring is the technical term, but really it's just people losing the lives and livelihoods that they've had. So we've been very concerned that we look after those people, and also that we get the economy reopened as quickly as it safely can be. And of course, that does ride heavily on having the pandemic brought to a decisive end as soon as possible.
Any timeline? I mean, if we're now February, if we continue as is, how long before this scarring, as you called it, really has a negative economic impact that's even more permanent?
It's very hard to say. If we, I would say that we seem to be on a path to avoid. We haven't seen the kind of scarring either among smaller businesses or among people that we have been concerned about. We haven't seen that. The labor market's come back faster. The level of bankruptcies has been lower. It's happening, but it's happening at a much slower pace. You see the cases coming down, you see vaccinations happening. We have the prospect of getting back to a much better place in the second half of this year.
Understand. Thank you. And Madam Chair, I yield back.
The gentlewoman from Michigan, Ms. Tlaib, is now recognized for 5 minutes.
Thank you, Chairwoman. Thank you, Chairman Powell, for being with us this afternoon. I wanted to start in talking a little bit about my district. When we do discuss the state of the economy, I believe our hyper-focus on the stock market always has us forgetting the dire situation for our low-wage workers. And let's remember that half of the American people do not own a single share of stock. And we continue to hear about how the stock market is booming and the economy is bouncing back. But where I come from, Chairman, we are not seeing that recovery. The national unemployment rate in December was 6.7% nationally again. But in Wayne County, Michigan, the district I represent, it was nearly double, 12.4%. So we know that software engineers, our investment bankers, attorneys might be able to do their jobs remotely. But if you are a taxi driver, a restaurant server, a barber, you cannot work from home. So as of last month, our employment in the lowest paying job tier was at 20% below pre-pandemic levels. This is why I continue to call for reoccurring monthly payments of $2,000. So Chairman Powell, in your opinion, what would sending $2,000 check, a $2,000 survival check to every American mean for the health of our economy, and what would it mean for our nation's most economically vulnerable?
I'm very sorry. I don't want to talk about a provision that's actually in the current bill. I will echo, though, that we see the unemployment rate. Your situation is not uncommon. There are many communities where the unemployment rate is 20% now and higher. So we do get it that some parts of the economy have a long way to go.
And I think this is why the supermajority of Americans actually support monthly 2,000 checks that would lift and help millions out of poverty. Our immediate priority, as you all know, should be taking care of our American people struggling to make ends meet. The Federal Reserve's own monetary policy report shows that Black and Brown communities are overwhelmingly left behind during this economic recovery, Chairman. So what is the Federal Reserve doing specifically to address both the racial and social economic disparities that exist in the economic fallout from the COVID pandemic? Can you speak about that?
Sure. So with our monetary policy tools, they really lift the whole economy. But we made fundamental changes in our monetary policy framework last year, and did so in part because of what we saw happening in low and moderate income minority communities, with at times of very low unemployment. So we've said that we won't tighten monetary policy just because of a very tight labor market. We'd want to see actual inflation or other issues that would potentially derail the recovery. So that, I think, will, in the long run, be something that does benefit lower income people, communities of color.
So specifically direct payments, is that what I'm hearing?
No, really just that we will keep our rate, our policy rate low, and encourage the economy to become very strong before we start tightening policy. And that's what we've, the guidance that we've given, by the way.
Yeah. I don't know, for my residents at home, they want to be able to pay their rent, their water bill, utility. I'm not sure if that's going to work in Black and brown communities, Chairman. But last month, over 100 leading economists urged Congress to pass a strong stimulus package, as you know, with comprehensive recovery from the pandemic. So I think we need to look at some of these economists who are saying that direct checks to individuals, like many other countries have done a number of times, and it's also very much tied into the unemployment rate. There are different kinds of triggers. I think we need you to take a lead in how we can really truly help address some of the racial and social economic disparities. Many of these communities, Chairman, were already in survival mode before this pandemic and now are really truly suffering. And Chairwoman Waters knows the stories in my district. I even mentioned one woman who said, please, Rashida, help me find another place to put my child in early childhood education program. I said, don't worry, I'll find you a different place. They can do it virtually. She goes, you don't understand. I need to be able to send her somewhere physically so that she can eat twice a day. So we need to understand the dire need on the ground. And Chairman, I know that you have to look at it more as a bigger picture, but understand your Federal Reserve own report says that you're failing in servicing, again, communities like mine, and we need to do more and be much more aggressive. Thank you so much, and I yield.
Thank you very much, Ms. Tlaib. The gentleman from Tennessee, Mr. Kustoff, is now recognized for 5 minutes.
Thank you, Madam Chairman. Women, thank you for calling today's hearing along with the ranking member. Chair Powell, thank you very much for your leadership over this last year during the tenure of your chairmanship, and especially the last year, because the economy really is performing much better than probably any of us would have thought a year ago at the onset of the pandemic, and your leadership is in large part a result of that. I do want to ask you, though, and I realize that we can all selectively pick out economic data, but on the heels of two things. One, the retail sales numbers that came out last week that were much stronger than I think anybody expected. And also, Chair Powell, with the CBO report that came out several weeks ago that predicted that the economy would grow by 4.6% in 2021 without any stimulus. So, before I hit you with the question that you won't answer, I am going to ask you, what are some of the reasons that you think the economy has? Would you agree that the economy has performed better than we would have thought?
Well, I just think as a matter of fact, it has performed better. If you look at where generally private sector and our forecasts were in April or May of last year, what's happened is the economy's recovered more quickly, generally, continually. And even as waves of COVID have happened, the economy has proven able to deal with those as the people have found ways to cope, businesses have found ways to cope. So we're still a long way from our goals, but we're not living the downside cases that we were so concerned about in the first half of last year, and that's something to be very grateful for.
So, Chair Powell, with the CBO report, with the economic data that we've seen, the fact that in the other stimulus packages that we passed last year, we've got roughly $1 trillion that hasn't gone into the economy that we've appropriated. From a timing perspective, and I know you've advocated to go big. From a timing perspective, would we be better off, would we as a nation be better off waiting for some of that money to start circulating through the economy before approving another stimulus?
That is an important question for people who are elected to deal with those issues, and it's really not something that you want your Federal Reserve, which says we have this independence, and I think the other side of it is stick to your job. And I think I just would defer to those of us who've stood for public election, which nobody elected us. So,
all right, fair enough. If I could, one thing I think everybody can agree on is the need to get our children back into schools. And we know all the concerns that parents have, that students have, that teachers have, that educators have. I do want to ask you, though, has the Federal Reserve done any analysis on what school closures have done to employment in the United States? Or is there any data on that?
Yeah, there's quite a lot of data on that. And there's also research that people are doing that tries to quantify, very difficult to do this with confidence, but tries to quantify the burden that kids who miss a year of in-person schooling will bear through their economic lives and the effect that'll have on the economy. So there's a lot of data and a lot of research. If you have something specific, we'll be happy to find that for you.
Well, and I was going to ask you about where you were just going a moment ago, but in terms of the school closures on parents, grandparents, family members, the fact that their children, relatives are at home, is that affecting employment in any way, these school closures?
Well, yes. I mean, in particular for women, many women have, women's labor force participation dropped more and is still below that of men. The net drop went down and then moved back up, but the net drop is still larger than that for men. And that's because women have taken on more of the child care duties than men have in this time when kids are going to be at home. They're not going to be at school in many places.
Thank you, Chair Powell. And last, if I could, a China question. About a month ago, China released some statistics that showed that their economy, in fact, grew 2.3% last year in the face of a pandemic. Very quickly, do you believe that data?
It's always a good question. I don't have anything new to say on that. We don't have the kind of transparency into their data collection that we have for many of our other nations. But, directionally, it's probably about right. We don't know how precise it is or how accurate it is in measuring economic activity, but it's probably better at measuring the change than the level, if you know what I mean.
Thank you, Chair Powell. My time has expired. I yield back. Thank you, sir.
Thank you all so very much. I'd like to thank our distinguished witness for his testimony here today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to Chair Powell for his response. I ask our witnesses to please respond as promptly as you're able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned.